In order to really ensure that inflation's back to target, we think you do need to see some more labor market loosening.
We still have more and more evidence pointing in the direction of the labor market softening.
I think there is still some underlying strength in the labor market.
The jobs market now is coming into question in terms of how resilient it really is.
The employment rate will move up, and as you know, I've mentioned before, I think we'll probably have a hard-ish landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get you to the weekend. It is Payrolls Friday, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market just about positive on the S&P 500. TK, your number, the estimate in our survey this morning, 183.
And I folded right into claims from yesterday. I double barrel them, and the answers claims came out. It was a yawn. It was a snooze fest. Do we get a snooze fest today? Or either way, do we get some form of major market response? It's been interesting to see how markets have locked down since, say, 6 p.m. yesterday.
It's the first chapter of a three-part act, TK. We've got CPI, Bramo, next week. And then, Lisa, it's on to the Federal Reserve.
Yeah, and how are they going to interpret this, given the fact that they really haven't pushed back before the quiet period, as much as some people thought that they might, to the easing financial conditions? Just to give you a sense of how much financial conditions have eased, spreads, the extra yield on high-yield bonds is now the lowest going back to 2021. We are talking about a massive retracement of some of the risk-on kinds of feels, which raises this question, okay, have we eased too much, given the fact that we still have a robust labor market?
Do you want the pushback this morning? It comes from Marko Kolanovic over at JP Morgan. Here it is. Here's the quote, Tom. The risk-reward in equities and other risk assets is worse than in cash or bonds. He calls it a catch-22 situation. We would need to first see some market declines and volatility during 2024, Tom, before easing of monetary conditions and a more sustainable rally.
It's a class note. He leads it with a single sentence of 2023. He thought it would be slow. It wasn't. He was wrong, period. So he readjusts, he recalibrates like everybody else, and the bet here is for a more subdued market.
What did Bramo say? We got the grow before we got the slow.
I think Steve Whiting said that earlier to Balin.
Hold on a second. There is this sort of question where people are betting on a slow and then grow. So can you bet on the growing before the slowing? And this is a real question, because can you expect some sort of rebound in growth if we haven't even seen the downturn that's necessary to get there?
Thank you so much for clarifying that.
You're welcome.
Here are the scores this morning.
Please give us some math.
We look a little something like this on the S&P. Futures just about positive by 0.05%. 3 days without gains on the S&P. And then we bounced, and we bounced hard, led by big tech. In the bond market, yields a little bit higher by 3 basis points. On a 10-year Bramo, 417.97.
There is only one event today. It is the 8:30 a.m. non-farm payrolls report for the month of November. I'm watching the unemployment rate, because even if you get a good payrolls number, do we see an ongoing tick upward in the unemployment rate? The expectation is for it to stay at 3.9%. If we get to 4%, even if it's a good number, does that change the conversation just a little bit about the nature of who's getting hired and who's not staying in the labor market? Today, we get reaction from the report from Jeffrey Rosenberg of BlackRock in the 8:30 half hour. And then in the 9 a.m. hour, Bloomberg opinion columnist Mohamed El-Arian and acting Labor Secretary Julie Su will be joining Jonathan Ferro. At 10 a.m., University of Michigan Sentiment Survey. I am really excited for this one, because this gives you a sense. No, this actually is important this time. No, it actually is.
I'm agreeing with you.
Okay, so the 5 to 10 year inflation expectations ticked up in the last survey to the highest levels going back more than a decade. Do we see that continue, or do we see that come back down? The expectation over the next 5 to 10 years of 3.2%, which went up even as gasoline prices went down.
How can we look at 5 to 10 years? That would be my arch question. I mean, who's making that guess?
You Mitch ask that question every month, Tom. It's a beautiful thing.
I know they ask it, but I don't know what the value is, because I really don't know, where am I going to be in 1 year?
Once put a lot of weight on it, and then all of a sudden did not put a lot of weight on it, Tom, and kind of turned his back on all of that. Steve Whiting's with us, Chief Investment Strategist, Chief Economist at Citi Global Wealth. Morning, Steve.
Good morning.
Before we get into the big outlook for 2024, let's talk about 8:30 a.m. this morning. What are you looking for?
Well, look, I think that the forecasts for 180,000, are unbiased. This is not the seasonal extreme of the year. We're still in a seasonal upswing in hiring in the month, but not as extreme as the month of October. I mean, the big picture on this is this year, employment gains, 239,000, a little more than half of last year's gains. And you know what's coming? The coming year, it's going to be slower still. And that's going to matter for the Fed. It's going to be in a different situation for other parts of the economy where, we've had this very large rebound in labor-intensive services hiring for a couple of years now. And it's given us this period of monetary tightening deep into a period when a lot of industries have adjusted, but labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
Do you agree with Bank of America's Michael Hartnett that essentially, he has a fancier way of saying this, but bad news is now bad news, and that essentially if you get a rally in treasuries, that's going to be negative for risk assets?
Bad news for whom? For what? I don't really believe this. I think that productivity growth is rebounding. Again, it may have gotten exaggerated in the third quarter. The labor market has been strong. Measured inflation is going to come down. Right. The Federal Reserve is going to swerve to trying to protect the expansion that we have. And that's going to be good for financial markets.
I think first of all, bad news is defined this morning as Juan Soto going to the New York Yankees. That is bad news for Red Sox.
That's bad news for the Red Sox.
That's bad news. It's like the way the Tots lost yesterday to West Ham.
On that.
Which is bad
Unbelievable.
News.
You are the single best I know at folding profits into our economics. And the key thing here, and Lisa's wonderful observation of grow and slow, is can we get both? Can we get a slowing economy, and yet corporations will adjust to a lower nominal GDP, and they're still going to grow profits?
So if we take a look at this year, for the most part, it hasn't been a great year for profits. Through mid-year, EPS were down 6%. The majority of industries had a decline in profits. This is why the S&P equal weight index is up 6% and the headline's up 19, for market cap. This is the reason why most stocks are not doing well. Right? Now, this is not a collapse. This is not a depressed period where you can have a V-shaped recovery from it. But profitability, I think, is going to be coming back. Manufacturing across the world has contracted for a year. Trade has fallen as much as 9% across the world. It's really quite coincident with what's going on with profits. We've had this pre-recession in industry, except for employment.
I like that phrase.
Well, the employment side, again, has been held up by this rebound in services. Everything's been out of sync since the pandemic, and everyone just focuses in on that, but that's the piece that I think slows going forward.
We just put up a non-farm payroll survey, your middle tendency here in the parlor game. Give us the SPX parlor game. Fold your economics into where you think, and I don't mean what David Balin says or Citigroup, just your basic idea that if corporations grow, can we have a more optimistic
Yes,
nudge up?
I think we'll have a new record high in U.S. corporate profits by early 2025. It won't be quite as good as the consensus estimates, but those are known to be biased upwards. I think we're going to beat estimates for the next couple of quarters quite handily, while rates are coming down, employment is slowing, and the Fed is swerving.
So you're whispering in Jane Frazier's ear 6,000 on SPX?
Well, someday, but that's that one's pretty
someday. There's the answer.
Is there a home bias to this call on stocks?
Well, I think we for the last 3-4 months, been focused more in on U.S. performers, small and mid-cap growth stocks that are under-levered, have strong EPS growth and trading at 15 times earnings. Why were they all left behind? Last year's Magnificent Seven had EPS declines. Now they've had very, very big gains. And if you take a look at that reversal, I think we're going to get other pieces of the U.S. market to rebound. And then I think we could broaden out to the world later on in late 24 into 25.
The banks are part of that story.
Well, it's very interesting. I mean, they're trading at 45-year relative lows in terms of performance. They could bounce back, and yet this is not really about long-term growth. We see a lot of areas of very interesting long-term growth that I think would be sustained for a longer period of recovery than a bounce back.
So I've been looking right now at credit pretty intensively because it's been moving along with equities and then some. I misstated earlier, high yield bond spreads are the lowest going back more than a year, April 2022.
Outperformed those small caps.
Outperformed the small caps, outperformed a lot of aspects of the equity market. People talking about a golden era for credit of all sorts. Is that fading now?
Well, look, I'm not sure that the rate environment really, should be discounted here entirely and should look only at spreads. If you take a look at private credit yields, 12%. Companies that are not part of the bond market paying 15%, that are money good. So yield levels, borrowing costs across the economy are up a lot.
Yeah, but just riddle me this. How we can have companies that grew up with paying 4% or 5% for their debt suddenly having to pay 15%, and that doesn't somehow diminish their creditworthiness in a material way? How have we gotten to this space where suddenly they can manage payments that 5 years ago people said was an impossibility?
Well, zero was, we never really got to the point of embedding zero forever. I think in some valuations. And I think that the forthcoming maturity wall is pretty empty for 2024 for both high yield and high grade. Then you look further out, it starts to become an issue. But I think we overshot a little bit on rates. Now, again, these are more normal yields than 2020, but we're not going to 1980 either.
I'll be criticized for this, but I'm going to go there. 2023 has been one big value trap. Everybody said, I got to go to value. And as a general statement, it hasn't worked out. What are the signals where all of a sudden value's not a value trap, where it has value?
2022 was the period where defensive value performed really well. Large cap pharma. Now you have some interesting stories. Talk about a narrow market of, GLP drugs and two companies. I think
Let's
again.
talk about that. Is the sector more than just that?
Well, again, through tech, through healthcare, it's an incredibly narrow tape. And so the value trap is partly a consequence of things are just not that great for most companies. And where are they headed? So they should hire everybody. They should have 239,000 jobs per month. No, they won't. And so that's the piece that will slow. But a lot of the cyclicals, which some of them fit into value, I think will recover in the coming year.
Energy too?
Look, I think we're at an oil price. Let's just remember that the last 4 recessions, Brent reached lows averaging $24 a barrel after the last 4 downturns. We think that OPEC is, at least our take on this, is managing to decline in terms of their output, in terms of their influence, but boost the oil price in the process. So they're giving a gift to oil producers and the rest of the world.
You guys had the call of the year with a guy named Edward Morse. He's pretty good at hydrocarbons. What are you going to do when Morse walks out the door? He's of an August age. He's announced his retirement. What do you do on hydrocarbons if a guy like Morse exits stage right?
He's been a great partner and will continue to use a really, really strong commodities team.
Does he know you're calling $24 a barrel for oil?
No, you misheard me.
I misheard you. That's part of the act, Steve.
No. Okay. Yeah, 75, not 24.
So the average is 24 over the last 4 downturns.
Yeah, at the bottoms.
Big skew
the last 4
from
downturns.
The pandemic, though.
Yeah,
Big
and
skew.
so look, I think that we're going to there's a lot of risky oil around the world. Russia and Iran are 20% of global output. Now, they have all the incentives in the world to keep producing, but the oil price on average, we think with OPEC cuts, is going to be higher. And that is going to benefit all sorts of conventional and alts, at least compared to where they would be at a collapsed oil price.
I think we can suggest that maybe that number is distorted by those negative prices we had 3 years ago. Maybe just a little bit.
Yeah.
Just a little bit.
I'm not counting futures, I'm counting spots.
Okay, interesting. Thanks for that, Steve.
All right.
Appreciate that clarification. Steve Whiting there of Citi Global Wealth. Let's go to the broader price action going into payrolls. The scores look like this in the equity market. Futures just about positive by 0.05% on the S&P. Yields north of 4.1%, getting closer to 420, Lisa. Up 3 basis points to 418.16.
Yeah, but really, this is the stability people were looking for. I mean, the sense that we're not necessarily cratering and we're not exactly skyrocketing. The fact that even on the heels of a potential shift in Bank of Japan policy, we're getting such minor moves really highlights how much the landscape has shifted and how people are sort of stable in this landscape.
There was nothing stable about dollar yen yesterday afternoon. Do you see those moves, TK? Dollar yen at one point, negative 3.8%. That currency pair just cratered yesterday afternoon.
This is strong yen, and some of the movement there persists this morning as well. And I'm sorry, it sets us up for Sunday evening our time. When are they going to do this? They're going to do this over the weekend. They're not going to do this Wednesday.
Oh, you think they're going to hike rates over the weekend?
No, but I got my radar up. I mean, I've canceled. I've blown out my entire weekend calendar to wait for what the BOJ is going to do.
Right, okay.
I was going to decorate the tree, but we'll wait.
From New York City this morning, good morning.
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, today on Bloomberg Television and Radio.
For Israel to say that they are going to eradicate or eliminate Hamas, I don't think that's a possible goal to achieve, simply because Hamas is not in Gaza only. Hamas is in Lebanon, Hamas in leadership, everybody knows, in Qatar, and they are here in the West Bank, and so on and so forth. So what is needed really is a situation in which that Palestinian unity should be allowed to function on very clear bonds and agenda.
Fascinating conversation. That was the Palestinian Prime Minister in a conversation with Bloomberg in the West Bank on the challenges Israel faces in its goal of destroying Hamas. More on that in just a moment. From New York City this morning, good morning. Payroll's just around the corner, 2 hours and about 13 minutes away. Your estimate this morning, TK, very, very close to 180K. 183 is the median estimate in our survey, and equity futures are going absolutely nowhere.
I'm going to go to where Lisa was earlier, on something as boring and staid as the unemployment rate. And John, you're going to have a conversation with the Department of Labor here in the 9 o'clock hour. And I'm sorry, there's a huge difference off 3.9 of 4.0 or 3.8. And just that little tick may do more than any other data point. 4.1 would be, wow.
The lower the cycle, Lisa, 3.4% on unemployment. It matters.
Yeah, 0.5% increase, and that actually is sort of a key metric as we head into whatever happens next.
And Claudia Sahm has said the same thing. She said, there's over-analysis of her Sahm rule, except today it may matter.
Yeah, I think everyone's going to be talking about that Sahm rule.
Yeah.
Maybe butchering it. I know she gets frustrated about it. We'll catch up with Claudia, hopefully, in the next few weeks, Tom, to clarify what she thinks it all means.
It's going to be interesting to see, to say the least. What we know is into the weekend, we will see more news and mystery out of a war in the Eastern Mediterranean. We've had the huge advantage of the services of Norman Rule, former senior U.S. intelligence official, non-resident senior advisor at CSIS, the Transnational Threats Project. Norman, thank you so much for a Friday visit this morning. I see Secretary Blinken essentially lecturing the Israelis. Is the Israeli military, and I believe it's Khan Yunis, 4 miles from the Egyptian border. There seems to be 2 conversations going on, a military prosecution of war, whatever, conflict, and as Lisa's beautifully said, the after the debate matter. Which is more important?
Well, good morning. Both are not only important, but they must take place in parallel. And actually, there are several conversations that are happening in the region. You first have the issue that Israel remains committed to the eradication of Hamas as a military threat. And the United States, for whatever the Secretary's comments might be, is committed to providing them with the material support to do so and the political space to get this done and recover hostages. You then have a very real humanitarian crisis, which is getting worse daily, that must be addressed. And this is going to put limits on the Israeli operations. And last, to your point of the day after, you have a series of growing diplomatic efforts involving multiple international partners to put together a structure that doesn't have very strong scaffolding within it. The Palestinian Authority, the Israelis, even the international community is not very well structured to support a day after architecture at present.
You were saying that Israel's goal hasn't changed, and we were just hearing there from the Prime Minister of the Palestinian Authority saying it's not possible to achieve that goal, to get rid of Hamas. What's your sense on that?
It's certainly possible for Israel to destroy, to kill Hamas's senior-most military leadership, and they're doing a pretty good job at this within Gaza right now, having taken out several dozen Hamas leaders. They'll also be able to destroy much of Hamas's military and technical capability. but I don't think Israel believes it's going to be able to kill 33,000 fighters. And there are Hamas operatives in West Bank, in Lebanon, and in Qatar. The question is, if you go into the Palestinian Prime Minister's comments, if he wants to make Hamas a junior member of a Palestinian coalition, will Hamas agree to accept the state of Israel? Or will you have a coalition in Palestine that includes a prominent partner, likely the one that would win an election if an election took place in the Palestinian territories, and that partner is dedicated to the eradication of the state of Israel?
I have to wonder, though, what Israel is losing in the process as this drags on, because there are thousands of people who are dying. You mentioned the humanitarian crisis that is mounting, a lack of access to clean water, a lack of access to health care, crowded conditions. This is all creating and breeding disease and hunger that could potentially kill more people than the conflict. At what point do you kind of get on board with what Lloyd Austin is talking about of the U.S. when he says that Israel risks a strategic defeat even if they win in their objective?
Israel probably has a matter of weeks left to conduct these operations, perhaps through mid or late January. But it's also important to understand that Hamas knows this, and Hamas is using these humanitarian losses to build world opinion against Israel. And Hamas's survival rests within the concept of, if there is enough pressure on Israel to stop operations, Hamas survives, the resistance is proven it's successful, and that itself could doom a two-state solution, if only because Hamas, which has survived, is committed to the eradication of Israel.
How do you have a two-state solution with a group like Hamas?
You can't. You need a Palestinian Authority or a Palestinian entity that's willing to accept Israel, just as you need an Israeli government, which doesn't necessarily exist at present, that's willing to make significant political concessions to Palestine.
So in 5 weeks, you're suggesting, based on decades of experience, Israel's done with whatever they're done with. Then what?
There is a significant, robust diplomatic effort behind the scenes right now to build this, and this is not certain, and it's very challenging. Will Prime Minister Netanyahu survive? Can the Palestinian Authority actually run Gaza? Is the international community willing to put skin in the game and the resources for what will be long-term and contentious negotiations? None of this should be taken for granted, but all of it is required if we are to prevent this from happening again. And last, Iran and its proxies won't stand by idly while this is occurring. Just as they put a spoke in the wheel of the Saudi rapprochement with Israel, they'll want to do the same thing as two states talks go forward.
So, Norman, let's talk about that and let's finish that. What can we do about the Iran issue?
Well, Iran has traditionally constrained its activities when it faces multilateral pressure, economic pressure, diplomatic isolation, and a genuine feeling of military retaliation. Frankly, all three of those are absent at present. Its proxies fire with very little response. The international community is fragmented. I think at present, right now, we just have to have assets in place for a worst case scenario and accept that Iran will keep things bubbling in various locales, much as they're doing at present.
Norman, thank you, sir. As always, Norman Rule there of CSIS. TK, we have to go back only a couple of months. We're on the brink, seemingly, of some kind of diplomatic agreement between Saudi Arabia and Israel, not in Iran's interest at all.
Every time we have Mr. Rule on, I learn something, and all of a sudden I have a 5-week window. I mean, here's somebody who's really experienced saying this military effort's out 5 weeks, 4 weeks, 6 weeks. Let's give it some wiggle room. But to Lisa's point, the then what is just extraordinary. It's like original.
There has been a quiet, though, from Saudi Arabia. And I think it's really important to note this, that there's a real question around what the political pressure is to stop this war from Middle East actors, other countries that previously were putting out certain rhetoric that didn't match with their actions. So it raises this question in the path forward. What role will Saudi Arabia play? Will they continue to try to normalize relations with Israel? What about Qatar and some of its negotiations to try to get some more hostages released?
It's important. I did a panel years ago. I'm not going to name a university. I'm at a panel with some fancy people, and they're trying to figure out what the Afghanistan society will look like after the war. And it was, seriously, folks, the most surreal panel I've ever done, and there have been some doozies. And the answer, John, is that's how I feel about this. We're all talking about what's going to be out there, and right now we're prosecuting a massive hand-to-hand combat 4 miles from the Egyptian border.
Yeah. Why can't we name the college?
I
panel?
don't.
Okay, no? All right.
Afterthoughts applying.
What the Secrecy Act's all about, but all right. We're going to turn our attention to the labour market. That report 2 hours away. Rabita Faruqi of High Frequency Economics joining us in just a moment. Your estimate 183,000, the previous number 150K. From New York City, this is Bloomberg. Two hours away from the jobs report. Here are the scores for you on the S&P 500. A day of gains yesterday. Decent day of gains across the board. The Nasdaq doing nicely as well in yesterday's session. This morning, just a little bit lower by 0.1% on the Nasdaq, just a little bit higher on the S&P 500. Let's call it unchanged, going flat, going absolutely nowhere, Tom. But in the bond market, we've been going somewhere. We have come down a ton from where we were the morning of the last jobs report, close to 5%, now close to 450, 462.25. Yields up by, let's call it 3 basis points.
Yeah, and over since Jobs Day, John, we just looked it up. You can do this on the Bloomberg Professional Service under the HP function. John, 4.99% last Jobs Day, just the day before, to 4.62 on the 2-year. And the 10-year yield was 4 point whatever, and we're already down to 4.18. I mean, we had a real, I think that frames it across a jobs report, the lower yield.
Has that been validated by the data, do you think? Is there a split between the economic data, what we're pricing, and what we're getting in terms of communication from the Federal Reserve?
I think you guys follow this more than I do. There's been a consensus view that the job market will weaken, and we're waiting.
Okay, pause, rewind. I'll ask the question again. Lisa, has this been validated by the data?
There you go.
Okay, not with respect to, well, hold on a second, not with respect to economic data. We just heard Steve Whiting there basically say, well, bad news for who? We've seen actually an increase in productivity, an increase in employment, different metrics. The disinflation, though, has been notable. And that, I think, is the data that has shifted and that has really spurred people to have a bid into bonds, even with a constructive backdrop in the labor market. This idea that we could get immaculate disinflation, that it was just transitory. It's basically the return of a narrative with nobody saying that this is the narrative they're all following.
I keep going back to what I've said over the last couple of weeks. The data's still pretty decent. I know it's disappointed relative to expectations, but output's still pretty strong, and we haven't seen a re-acceleration in inflation off the back of that. These disinflationary trends, Tom, have continued. Best way to capture that this week, the ISM. Headline number was decent, prices paid was lower. To Lisa's point on productivity, better, unit labour costs down. These are all things that the Fed was shooting for 12 months ago.
Is a generalization, disinflation benefits the haves within the financialization of the American economic experiment. Those in finance, those doing finance, they win, and the rest of America, there's a lot of pain out there, flat on their back. I saw a bankruptcy chart in the last 48 hours. It was grim.
Well, yeah, and you can see the dollar stores are not doing as well as you would expect during this kind of period of time. Look, there are many different layers, and this is the reason why we keep talking about rolling recessions, rolling economies, rolling market shifts, and I think that that's what makes it so difficult to get our hands around. Nonetheless, the bottom line is, can we have a job-full slowdown without any pain? Can we get some sort of slowing and cooling with it not being bad news, to Steve Whiting's point, to everything being Goldilocks until it's actually just amazing, right? I mean, is this basically the sort of baked-in understanding of what 2024 is going to look like?
I'd ask this, Lisa. How much of the rebalancing have we had so far off the back of the Federal Reserve tightening? How much of this has been about Federal Reserve policy? And if you do believe the cumulative tightening that's in the pipeline is still yet to come through, then the downturn's coming to an economy near you, isn't it?
That is an incredibly good point, and one that we have to really keep in our minds. And that's why I was asking about credit, because at a certain point, you got to think companies that got used to paying 5% are going to blink again if they're going to have to pay 15%. A lot of people would say that the tightening and the disinflation we've seen so far is the immaculate disinflation, is the transitory, and just has to do with year-over-year comps on the heels of the pandemic.
She's mentioned transitory 3 times.
Because that's what people are saying without saying.
Lisa loves the T word.
It's
big on the T word, this one, for a long time. Let's get to foreign exchange. Not encouraging that. Let's get to the euro. The euro against the dollar shaping up as follows. Just a final quote for you. 107 83, just about unchanged on the day. That currency pair negative by 0.1%. Here are your top stories under surveillance this morning. Counting down to the jobs report, just under 2 hours away. The median estimate in our survey calling for 183,000 on non-farm payrolls. A wide range of views on the street. Deutsche Bank at the low end, 130k. Goldman looking for a print, Lisa, of 238. Ian Shepperton at Pantheon Macroeconomics. What was he looking for earlier this week? 275. Oof.
But here's a question that I have, and I have this every single labor market report, but even more so this time around. Is the headline figure going to matter, or is it going to be in the payrolls, in the pay raises? Is it going to be in the jobless rate? Is it going to be in some of these other metrics that people are looking at to confirm either Goldilocks, a slowdown, or a re-acceleration down the line?
What's the UAW bump in this?
40,000.
40k, something like that. So we've got to subtract that and then focus on unemployment wages. I get it. That's kind of like the guidebook to payrolls a little bit later. Top story coming out of China. The top party leaders pledging to boost the economy as the country strives to reach its goal of 5% growth. President Xi Jinping saying the country will step up fiscal policy and be flexible and targeted with monetary policy, having previously talked of being, quote, forceful. We're reading the tea leaves here, Tom. China looking to fend off woes in the property market and a credit downgrade from Moody's earlier this week. Love this story from the Financial Times, giving you a little bit of colour on that downgrade from Moody's. Lead paragraph. Moody's advised staff in China to work from home ahead of its cut to the outlook for the country's sovereign credit rating, a suggestion staff believed was prompted by concern over Beijing's possible reaction. Some amazing reporting going on.
Friedrich Hayek on Liberty, John Gray with a wonderful one volume on that. And the bottom line is you have to clear markets, John. How do you clear a balance sheet challenge like property markets with the goings-on, the income statement-like matter of the Chinese people and the Chinese economy, given a totalitarian regime? This is an original experiment.
And, you know, they don't really want to increase leverage, so they're going to jawbone it as long as they can, which is how the market's basically taking some of these proclamations of we're going to support things, we're going to have fiscal policy, we're going to support you, and everyone's saying, yeah, you've been saying that for
Where's the avenue to write down balance sheet loss? I don't see it.
Can we trust research on China right now for anyone who has a presence in China?
I don't have an answer.
The fact that Moody's reportedly kept people at home ahead of the downgrade, Lisa, because they're worried about retaliation and what would happen?
Well, this building on the fact that China advised research arms of banks not to publish anything negative. So it raises this question, what do you want to publish? I mean, if you can't be analytical, and you call me a bear, but if you can't be skeptical, what are you doing?
What are you doing?
I think that it's a wait-and-see issue. We've seen this cycle many times before on the Chinese balance sheet. Does it unravel the same time with write-downs and, you know, policy prescriptions of thousands of people at a Congress, or is there a new calculus for President Xi? We don't know.
Lisa and I included this story just for you, the last one, this one here. The family behind luxury brand Hermes is now Europe's richest, with wealth of more than $150 billion, according to Bloomberg reporting. The family fortune up about 59% from last year, while shares of Hermes have risen 35% this year, far outpacing rivals, including LVMH and Kering. TK, you know this story, this family inside and out.
I sent this to Tara Patel and Angelina Raskoway. For anybody, this is the first read of the weekend, not because it's some fancy luxury thing, but it's where a family said no. And the bottom line is 15 years ago, they said to the guy that runs LVMH, Louis Vuitton and the rest, said, no, you're not going to take us out. And that's the heart of the story, and it's the way they did that. The one thing I would say, Lisa, that's important here with the Dumas family and the Hermes and all that, is they have taken over the craft French labor economy by setting up little outposts all over France, basically to co-opt the politicians. And it works like a charm, particularly Friday on Jobs Day, when with guilt you have to make an appearance, John, right?
Well, they're very good with select sort of restrictions in terms of scarcity. And they also are really good at saying some choice words to LVMH after rising 1,000% since that 13 years ago.
Can you share those choice words? What are those choice words?
They're fantastic words that I'm not going to share.
Okay.
But it's a great way of spurning, I'll just say that, spurning LVMH.
Lisa.
It's Friday.
That works on radio.
It's been a long week.
No, I get it. That's great.
Saving us shopping daily at Hermes.
There's always an extra layer to Bramo. You just have to keep pushing, and then it
really?
comes out. but then you find out what she really means.
Let's move on.
It's like the three of us are married. Rabila Faruqi saves us, chief U.S. economist, high-frequency economics. Rabila, I love your report and that it's very, what I'm going to call centric, predictable about this jobs report. To you, what is the unpredictable item at 8:30 this morning?
Good morning. We're really looking beyond the payrolls, headline payrolls number. We're seeing job growth is strong. It has decelerated a bit if you look at, the 2023 numbers compared to 2022. But it's really that unemployment rate. We saw a decline in the civilian labor force. We saw a decline in employment. And that's the part, I would expect that the civilian labor force part was an anomaly. But, it's that employment portion of it. And is that going to persist? So I think the unemployment rate is going to be important. That's also something that the Fed is going to be watching, because as inflation continues to decelerate, the effect of the full force of what they have done so far, we think that is still in the pipeline, and that's going to affect the growth trajectory, the labor market, and the growth trajectory.
Rabila, one thing that we haven't talked about ahead of this labor market report today is just the hours worked every week. And this is something that I see increasingly in a lot of different economic reports, that they're coming down and that this is sort of the precursor to a much more significant softening. What do you see in that? How important is the total hours worked each week?
It is extremely important. It is something that we are watching. It gives a signal about, conditions in the labor market and, how much, labor being put to use. And that is something that they're watching very carefully. But, at the end of the day, we also have to think about, the underlying, momentum in this labor market. That is still very strong. The underlying momentum in this economy is still positive. So, yes, we are getting signals. We're seeing job openings decline. We are seeing quits and hires normalize, but we are normalizing, right? We're not seeing yet any signal about a substantial weakening. That would be an alarm signal for policymakers.
John raised a really good point. How much of what we're seeing with the disinflation and the normalization is due to the Fed's policy, and how much is due to the T word that I keep repeating because nobody else will, that this was transitory and this essentially is a normalization after the pandemic?
This is something that we discuss at HFE very frequently, and we do find that, when we look back 10 years from now, that maybe this will be referred to as a transitory period of inflation. A lot of the stuff that has happened in inflation right now is supply side effects. Demand is still very strong in this economy. And, the Fed's rate hikes, yes, they have worked on certain sectors, manufacturing, housing, but the household sector has been extremely robust, extremely resilient. So this is where we think that, the risks lie, that the full effects are now going to show up, and that the pandemic-related effects like excess savings, pent-up demand for certain services, those are going to recede. And then now we're going to see a more substantial slowdown. We actually think we are still looking for a soft landing. We still think recession is not the most likely outcome, but we do think that recession risks are probably a little bit higher now, because of the effects of what the Fed has done and what they're going to do to the demand side of the economy now.
And this is why for so many, TK, bad news is just bad news.
I look at this on a demographic basis. Everyone from Rabila Faruqi to Alan Meltzer, the late, great Alan Meltzer, disagree with me on this. I disaggregate labor statistics, and to me there's not two, there's three Americas in this jobs report this morning. And there's a whole part of America, witness the bankruptcy chart that I saw the other day, that's not participating in all the fun and festivities.
Rabila, thank you. Rabila Faruqi there of High Frequency Economics. Takes me back to that quote from Marko Kolanovic in the last 24 hours over at JP Morgan in the investment bank. Lisa, a catch-22 situation. We need to first see some market declines, volatility during 24 before easing of monetary conditions and a more sustainable rally. To your point, you need the slow before you see the grow, right?
Well, this is the issue. Do you have to? And some people will say, like we just heard from Steve Whiting, well, if you get disinflation, the Fed doesn't really need to see the slow in the economy. They just see the slow in the inflation, and then everything is copacetic and they can keep cutting rates. A lot of people pushing back on that because at the bottom line, and actually yesterday, I want to just apologize for something. I was too bullish about oil prices.
Taking notes.
Because there is this essentially stimulus effort to individuals.
I love this. Stop. You got home. I watched back the show every day. I take notes on the guests.
I've never done
this. You guys all know this. And I'm listening back to Lisa and I'm thinking, this is too bullish. This is not Bramo. You did the same thing yesterday.
Exactly.
I thought, what was that?
Well, I just thought, I'm missing something, and I realized I got it. People are going to have more income. They're going to spend more, and it could fuel inflation because of the essential tax cut.
She's on the edge of data.
I can't.
That's what we call it, the edge of data.
What was yesterday about?
I mean, I was behind
You got home and said I was too bullish.
You listened back to
and I needed to correct it.
All healthcare, it feels like, has been discounted because what these drugs are going to do to the system. Again, it's going to do some good probably to the system long term, but not all med devices, not all healthcare companies in general will be hurt from this. There will be some that benefit from it.
That was Anna Mileti, the Allspring Global Management Head of Strategy, bullish on the healthcare sector, and healthcare likely to play a big part in today's jobs report. According to the team over at Bloomberg Economics, Chief US economist Anna Wong writing this, hiring likely was concentrated in only 2 sectors. Lisa, healthcare and government. We expect to see flat to marginal gains in other sectors with outright declines in manufacturing, financial activities and professional and business services. And this is the weakness, Lisa, people are talking about.
Especially because Ian Shepherdson with 275,000, who's expecting that number, back out 40,000 from the strike, back out another 50,000, he said, from government hiring. And then in addition to that, all of the healthcare hiring. Can you say that that is a bullish sign for our economy when these are basically staples and necessary hiring that goes to something other than just growth?
And John, I'm so glad you brought up this quote from Anna Wong, because she's had a terrific 2023, particularly in the 8s. I mean, going up to the high rates, and then boom, it turned on a dime. And that, for someone like Anna Wong, that's what happens. You get the call right, and then boom, it changes just like that. Well, is today's jobs day going to be boom for people that look at labor economics?
I think the challenge for a lot of people, you can get the Fed call right. You've got the call on the economy dead wrong.
Yeah,
it's been a challenge for so many people, TK. So even if you called, let's say 550 on Fed funds, what was your call on the economy? People were talking about recession.
Exactly.
Q3, north of 5% GDP. Shocking to so many people.
Is this report at 8:30 that kind of boom statistic that upsets the apple cart on people trying to make 3 calls? Rates, Fed, and jobs.
How much is healthcare hiring bullish? How much is that a bullish sign of the economic trajectory? That's one question that I have. I don't know. Honestly, this is one of the things that people are backing out to understand the components when you break down this employment report.
On this jobs day, and this is so important, I'm going to give John Ferro major cred here for driving this forward. I'm like, yeah, whatever. I'm going to try to walk another mile. My physical trainer, fine training.
How's that going?
Ted Fine, killing it. He's got me doing this. He runs marathons. He wants me to run a marathon. I said, what? Down to Dwayne Reed? Anyways, it's there. It's front and center right now. We're going to digress here with Dr. Fazeli. Sam Fazeli joins us. Senior pharmaceutical analyst, barely describes his competency on the moment, which is Ozempic and the rest of it as well. Sam, what's the future of all this weight loss, expensive drugs?
Well, hi, Tom. Thank you for the wonderful compliment, as always. The future, for one thing, talking about expensive, the future is going to be reduced prices. There's no doubt about it. There's going to be more competition. There's going to be more drugs on the market, and the prices for these drugs will continue to fall, even if you're not necessarily seeing them in what we call the list price, certainly in the net price that's coming down to payers. That's where I think you're going to continue to see pressure, and the volumes will keep going up.
Sam, you hold the mystery or the answer to the mystery that we see every single month these times when we take a look at some of the inflation reads and the jobs reads. Whenever people don't understand it, they say, oh, healthcare costs increased a lot or healthcare hiring increased a lot. What is going on and how much is it reinflationary versus disinflationary, the way that we see costs in a lot of other sectors?
Yeah, so that's interesting with regards to the healthcare employment being a key driver in the read that's coming later today. Because I think if it is, then it's going to be focused in specific areas. Certainly on the corporate side, what we know from the very large biotech sector, that in October 2023 was responsible for about 800,000 jobs in the innovative drugs world, that's been losing people. on an average 6,000 to 9,000 a month. And hiring has become much harder, harder for employees than employers. For each job, there's now 50, 100 applicants. So it's other areas of healthcare that I think are potentially driving this possible increase. And I have to say, it's probably likely because of the fact that we're still dealing with an aging population. That's not changed. And that's what's the basic demographic driver of healthcare and healthcare spending.
Healthcare costs are one of the biggest costs for a lot of households. We talk about the other components quite a lot. Gasoline, we talk about just sort of the food and basic goods that people buy. All of those things are going down in terms of price. And then we talk about healthcare costs. How much can this disinflation continue? How much are these efficiencies really likely before A, weight loss drugs really take effect, and B, in light of the fact that people are getting older and frankly, the age expectancy is going down, but not in a good way?
Yeah, I think part of that age life expectancy issue is because of what we went through with the pandemic, etc. And you know, there was a hiatus in treatment for many people, so that compounds the situation. But in terms of the future impact, you know, the sorts of drugs and therapies that really reduce the burden on the healthcare system, vaccination certainly one of them, but unfortunately that's going in the wrong direction in terms of attitudes. Drugs such as Lipitor, which are now generic and cheap, that reduce your risk of heart disease. Weight loss drugs, or weight loss in general. You don't need a drug to lose weight, but unfortunately, the impetus to do it and the exercise and diet is very tough, as we can see the evidence around us.
Yeah, but Sam, doesn't it go beyond that?
Cheaper,
can it be about addiction and treating addiction?
I think those drugs in general seem to be addressing your increased appetite for things, right? So be it food, be it alcohol, be it smoking. Can they be proven to be actually that effective? Time will tell. But if they are, I think this could be something that will pay off in 10, 15 years' time.
Got it. Could be absolutely massive. Sam, thank you. Sam Fazeli there of Bloomberg Intelligence. Lisa, we've talked about this a million times over, I know. But the use case of these drugs, still trying to figure it out, as Sam indicated there. Still trying to work out, Tom, whether you can treat addiction in other spaces. Yeah. With what's been unveiled over the last couple of years.
You know, as people know, John and I are barely on speaking terms, but John, you've provided great leadership on this. I mean, look at the causes of Ozempic: nausea, vomiting, diarrhea, stomach pain, and constipation. It's the same as Tang. I mean, it's like the same side effects as Tang.
Okay, we don't need to.
Where's this thing going to be in a year? Is the money question.
No one knows.
Yeah, I agree.
It's always about a story, though. And the story at the moment, Tom, you just look at the statistics, and we've talked about them, Lisa, a million times.
Huge.
And I will
One of the biggest killers in the West, heart disease.
Can I see on TV or walking down the street people taking Ozempic?
Yes, sure. Yeah. But here's the thing. Honestly, Sam Fazeli, who has studied pharmaceuticals and has a PhD in the matter, he came on and he said, people are tarring and feathering it, but it actually is incredibly effective and has been used for a long period of time and doesn't seem to have that many side effects. In diabetes, but there are these corollary effects to being obese that are significant, not to mention what John's talking about, which is addiction. And there are a number of studies coming out now that sort of suggest exactly that they can curb certain addictions. And this is another use case. It raises a question about how much we could potentially lower costs going forward. We were talking to Mark Rowan of Apollo, and he said people will find a way to kill themselves in other ways. But nonetheless, there is this thing about, how much can we really fortify our healthcare system?
You think that we stop eating and take on extreme sports? Is that how this works?
Are you looking at me?
Is that how this works, TK?
Pretty much.
Pull back on the booze and the
increase
and
the
fast
skydiving.
Food and more skydiving.
Why are you looking at me?
I'm not saying anything. I'm not sure who's left listening after you've put them off.
No, I think people are riveted by this. John, you've nailed this. I mean, people are riveted by this debate over this. Am I right? $9,000 a year drug?
As they should be, and we go over the statistics all the time. When you're talking about a nation where close to, what is it now? Close to 40%?
Oh, yeah, third at least. Yeah. Obese.
Yeah. Then this could revolutionize not just the lives of those people, but also the economy around them that we've built up over the last few decades. You can see how this can be so big.
Am I wrong that there's like a whole free lunch to this thing? Is that like too Calvinist where I'm like, it's just too good to be true?
I don't think there's ever a free lunch, right? You talked about those lovely side effects.
I
Nice.
don't know,
But when you talk about how much we spend on dialysis every year, when you start to talk about the concept of kidney transplants in this country, when you start to talk about some of these corollary things, these are some of the things, that could
Can you see her at Thanksgiving dinner?
I wasn't the one that mentioned side effects.
At the moment, I'd prefer Thanksgiving dinner with Bramo. You were talking about shooting up Ozempic on the streets.
No, can you see people on the streets? Can you, if you walk by someone, John, can you tell that they're taking Ozempic?
Yeah, dark alleyways, San Francisco.
I don't know.
Just shooting up Ozempic. That's how it works.
Stop. I think you meant in other ways.
I don't know why we're doing this on Payrolls Friday anyway.
Payrolls Friday. It's a digression.
Priya Misra, JP Morgan Asset Management, coming up shortly on this bond market on jobs and not on Ozempic. Equity futures negative 0.1% on the S&P, and the bond market yields look like this. Yields up higher, up by 3 basis points on a 10-year from New York City. This is Bloomberg.
You are going to see a slowing economy at the beginning of the year.
The real side of the economy, it does need to slow, in our view.
If rates are high for longer, which we expect, we will see some carnage.
We'll probably have a hard-ish landing. Not a hard landing, but hard-ish.
The path to a soft landing, to me, it always looked like slower economic growth. The hard part is sticking the landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market pulling back just a touch after a decent day of gains yesterday. We're down this morning by 0.1%. The estimates look like this in our survey. TK, our survey says 183.
A big morning, and frankly, I'm more engaged than I was an hour ago. The last hour's conversation really shows how interesting the data is going to be. Not just wage dynamics or non-farm payrolls dynamics, but just back to coarse numbers. You're going to speak with the Department of Labor here in the 9 o'clock hour. They're going to go to the unemployment rate. What's it going to do?
Were you disengaged the previous hour?
No, I've been into it for days.
Relatively speaking, more engaged. Okay.
No, but it made me ever more engaged in the 8:30 report because I think it's a huge mystery.
Keep it together, Lisa. The estimates look like this. 183 at the headline number. Unemployment 3.9%. The drift towards 4%. And Lisa, maybe beyond.
So here's my question. Which component of this report is going to take the headline? It's always sort of like a roulette around, is it going to be the headline number that people are going to talk about? Is it going to be the pay rises? Is it going to be the average number of hours worked? Or is it going to be simply the headline unemployment rate, given the fact that it has been creeping higher? And if you engage with the SOM rule, with all the caveats, it has reached the point where you have to say that there is going to be some sort of recession.
We've had a big move in this bond market. Wisdom Tree, they think this rally in treasuries needs to be validated. They go on to say this, Tom, a resilient jobs report will continue to provide the Fed with cover as to not have to move prematurely in cutting interest rates.
Yeah, but a rate's coming down not because of the Fed and the parlor game. A rate's coming down just because of gross nominal GDP and real GDP shrinkage. I looked at Atlanta GDP now solidly under 2%. This morning.
Honestly, I'm not sure that the Fed has any reason to hike rates further. The question now is just how big is the threshold to cut rates? And that's basically the message that we're hearing from everybody.
What's scary here, Priya Misra's going to join us, which is one. She's taking notes while we're talking, and I just looked over
definitely
and it
not.
says, Tom doesn't know what he's talking about,
They give that out to guess when they come on. It's just like a warning card.
It's a warning card.
Not Priya's. You get them when you make an appearance here, Tom. They give them out the back.
Yeah.
Let's get to the scores on the S&P 500. Equity futures pulling back by 0.1% on the S&P. Yields higher by 3 basis points. Lisa, the 10-year, let's call it 418.
All right, 8:30 a.m., 90 minutes time, we get that non-farm payrolls report. I'm personally watching the headline number. How much we get that 3.9% unemployment rate, maybe tick higher to 4%, or does it even just stay around 3.9% in order to dictate the next move maybe for the Federal Reserve? Today, we get reaction from the report. Jeff Rosenberg of BlackRock right after the report. And then in the 9 a.m. hour with John, we hear from Mohamed El-Arian as well as Acting Labor Secretary Julie Su. Very curious to hear the administration's take on a market that looks perfect. Can they keep celebrating this? I'm sure that they'll have actually a really great time just dancing around the numbers because it's a perfect kind of scenario for them. Am I wrong?
Isn't that what they always do?
Okay.
Dance around the numbers.
Yeah, but it's not working politically. I mean, let's not do Amory Horton
Thanks
here.
for joining.
Come on, look at his poll numbers.
Yeah, they're terrible.
It's terrible. I just
agree.
don't. The whole Bidenomics thing, I just don't get. It's not selling.
Well, you're not the only one.
Yeah.
Yeah.
Well, this is the reason why. We've seen sentiment decline, right? University of Michigan sentiment has come out, and it hasn't been as bad as some people expected, but we still have continue to see it go lower. This is the key rate. We're going to hear from this at 10 a.m. How much people's expectations for inflation 5 to 10 years out continues to remain at the highest levels going back more than a decade. Is this part of what's underscoring some people's skepticism about the economic backdrop?
Lisa, thank you. Thanks for the promo for 9:32.
No, hold on.
It's going to work.
No. I actually
tune in as they dance around the jobs numbers.
Well, what do you think that they're going to say? What's the message?
I'm with you. I get it. I can't say what I think. Okay. You asked a good question though. How high or low is the bar for interest rate cuts from the Federal Reserve? Priya Misra of JP Morgan writes this. I think the Fed starts to cut later than March, but cuts 250 basis points in a soft landing scenario, 400 in a hard landing scenario. So there is more room for rates to fall from here. Priya, I'm pleased to say, is here and joined us now. Morning, Priya. Let's just start with that bar and let's talk about the thresholds to cut. How are you thinking about that in terms of where unemployment needs to be, where core PCE needs to be?
Sure. So I think the Fed raised rates because the economy was very strong and inflation was much higher than their target. The reason we're all talking about cuts is that inflation has come down. Now, I will say it's been only a few months. I mean, I think all the factors that were there to bring inflation down, they're still there. That pace of decline, though, the market's pricing in a very quick pace of decline. So I think what the market's saying is we have this immaculate disinflation. The economy is okay, but inflation's going to be at 2%, so the Fed can start to cut. I'm not so sure about the immaculate aspect of that or the disinflation continuing to 2%. The labor market is still strong. I'll be watching that average hourly earnings number very closely. If you get 0.3, year over year wages is running at 4%. How does the Fed look at that and say inflation is going to be at 2%? So I think the threshold to cut, to your question, John, is high. They'll want complete confidence that inflation is going back to 2%. We've had few years of much higher than that 2% number. But, recessions are non-linear. The economy doesn't necessarily respond that quickly to rate cuts. So I think once they start to cut, they'll be in a soft landing scenario. They'll want to take rates back to normal, neutral, 3%, let's say, 2.5% to 3%. But they'll start late, and, that's when I think all those cuts will happen. In a hard landing, again, I think they start late. Unless the unemployment rate spikes a lot today, then they've got a lot more room to do because they have to take rates to accommodative, not to neutral territory.
You said two things there that are polar opposite potential outcomes. One is the immaculate aspect you don't buy. You think that there is some sort of pain, or else you get inflation that is stickier. It's sort of those two poles right now that seem to be at play. Which seems more likely right now based on what you're seeing in the economic data?
So the economic data suggests cracks here, but not enough for me to say that the hard landing is right here. We should all be very humble about recessions. They never happen, right when you expect it. We're not exactly following any recession playbook. People have been looking for a recession for this year. I would say the data just suggests slowing down. But on the inflation front, I would argue that the data suggests it's slowing, but that trajectory down to 2%, that speed is what I struggle with. So I would say we're right now looking like a soft landing. Immaculate disinflation's been what's happening, but we have to be humble that the data can turn very quickly.
It seems like everyone is buying transitory without saying transitory, that essentially the disinflation that we're seeing is just a right sizing, that maybe the Fed had something to do with it, maybe not. Maybe we're just immune because they're going to cut rates back down to where they were before or close to it before they have any chance to really work their way into the system. Do you buy that? Is what we're seeing right now entirely sort of just the transitory aspect and not due to the Fed policy rate?
So I think that word has been banned from Fed speak, the transitory word. But I would say the supply side, which I hope the Fed brings it up. The supply side worked, right? From labor force participation going up, supply chains are much better. So goods inflation, that's why it's been declining. But I will say that there's components of demand. Look at housing, and that's going to continue. So I don't want to say that inflation is going to re-accelerate. From the housing sector, I think rent inflation is going to continue to decline slowly. What I struggle with a little bit is core services ex shelter. How quickly does that come down with a tight labor market? And that's what we'll be watching for today. That can start to get a little sticky on the way down. And if it gets stuck at 2.5, I think this Fed is telling us, no, our target is 2, not 2.5. That's why that threshold for them to cut rates is still higher than I think what the market's pricing.
Translate this to the real yield, the 10-year real yield, and I'm going to call it a 2.00, 2.01 today. We've seen 199, 198 as well. But I don't think business people really understand the nonlinearities you can have in the inflation-adjusted yield. Are we going to get a rapid decline in the real yield here in 2024?
I think for the real yield to decline that much, you need to have the Fed starting to cut and the economy heading into a hard landing. So as much as I think real yields are what you should put in your Christmas list and buy some, especially if you own some risk assets, I think, it'll only come down, like say below 1.5 when the Fed starts to respond. So they need to see that unemployment rate get closer to 4.5 or 5. That's when they're going to say, okay, this is not soft landing. This is looking like a hard landing.
Scope and scale that, because the real yield going up has been extraordinary here. Are you talking 150 real yield the end of next year?
Well, I think the economy is heading into a hard landing or a hard soft landing. It's kind of, tricky what you even call this.
What is that? Tell me what that is, please. What is that?
If the unemployment rate is at 5, is that a hard landing or a soft landing? Okay. I would argue it's a hard soft landing or a soft hard landing. But this is tricky.
Do you want to go sit next to Abramowicz?
End of cycles are always hard. All the data is giving us mixed signals, and we're trying to, and the market's perfectly priced for a soft landing. So I think that's why it's going to stay volatile. The narrative.
She didn't answer my question.
Well, Priya, you've said this before, and Lisa has talked about this lots as well. When you start to see this conflicting, contradictory signals that we're getting right now, you're at a turning point. I just wonder what that means for the Federal Reserve next week. So let's play SCP roulette. You get this summary of economic projections. We know where they were. Talk to me about where they will be next week once we get these new forecasts from the Fed.
So I think their forecast for the unemployment rate will likely be higher, and their forecast for inflation will be lower. So the dot plot that the market really obsesses about had shown 50 basis points of cuts. I actually think it's going to show 75, maybe even 100. Now, that's less than what the market's pricing in, but I think the market has to price in an economic outlook and a reaction function. I think the reaction function will sound a little hawkish, but the market can price in, weaker growth. We have inflation before that as well.
24 dot, where is it?
I think it shows 3 cuts.
3 cuts?
From the Fed median.
Is that enough for the market, do you think, or is that pushback? How would you frame that?
I think it's enough for the market to keep those cuts in there. Depending on what happens today on payrolls as well as inflation, the market might reduce some of the cuts, I think, in 24, but put more cuts in 25. Because remember, the economy is also evolving. If we see the slowdown, and we should debate, does every cut of the Fed matter? I mean, the hikes didn't matter for quite some time. Will 75 of cuts really help the economy? So I think we should be ready to price in more cuts in 25.
Can you help us answer that? If the hikes didn't hurt, will the cuts help?
They help financial conditions. I think equities will love it. But then we have to look at the data and realize that it just might take a lot longer. The lags work both ways. So I think we're in for a volatile next few years for risk assets as well as the economy.
Priya, thank you. A soft hard landing or a hard soft landing? Did you get that, TK? Tom loves this stuff.
Get me going. I just think it's just parsing it too near. I'm very interested, though, in the ambiguity of where the real yield is going. To me, that's got a lot more reality.
If you are just tuning in, session lows, by the way, on the S&P 500. No real drama, though. We're down by 0.2% on the S&P 500. Yields up just a couple of basis points by 2 or 3 basis points this morning. 417.59. Priya, good news today. Bad news. How are you playing that game?
I think it's a little asymmetric, actually, meaning if you get a weak number, there's this nervousness in the market, and we're perfectly priced for immaculate disinflation, soft landing. If you get 100,000 on payrolls, I think the rate market's going to say, oh, the Fed's starting to cut right away.
Yep.
Risk assets are going to say, whoa, that's not so great. This looks like a hard landing. So I think you'll get a bigger reaction with a weak number. I think a strong number is largely priced in.
And good news is kind of good news, right, at the moment, so long as you get these disinflationary trends. I'm with Priya on this, 100 sub 100. If I wanted fantastic entertainment at 8:31, that's the number I'd pick.
Sub 100?
I'm not saying that that's what I want. I'm just saying that that's the number I'd pick to say, to see how the market would process that. I think you'd learn a lot. Let's see if it's like 90-something. What do you do with that? Do you start to get concerned about an economic downturn?
What you do is you call David Kelly at this small bank in New York, J.P. Morgan. You say, David Kelly, you nailed it. He's been calling for this trajectory for months and months and months to a negative non-farm payroll statistic.
To me, what Priya said there is lags work both ways. And the idea of will cuts matter, to me, is one of the biggest questions going forward.
Yeah.
What they will matter for is actually, to Tom's point, the movement of cash. Because at a certain point, people won't want to hold their money in money markets as much, and they'll put them elsewhere. Some really interesting dynamics heading into next year.
Obviously, what I'd really want is just forever cycles. Payrolls at 200K and everyone's happy. That's what I'd really like for Christmas.
Who is this? Where did we put John Ferro?
I'm going to enter Miss Universe. That would be my answer. What's your biggest wish? I'd be like 200K every single Friday of every first week of the month. And they'd be like, what are you talking about?
You'd be like, hi, elbow, wrist, wrist.
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, today on Bloomberg Television and Radio.
Israel probably has a matter of weeks left to conduct these operations. Hamas knows this, and Hamas is using these humanitarian losses to build world opinion against Israel. And Hamas's survival rests within the concept of, if there is enough pressure on Israel to stop operations, Hamas survives, the resistance has proven it's successful, and that itself could doom a two-state solution, if only because Hamas, which has survived, is committed to the eradication of Israel.
He has just been one of the absolute best on this topic over the last 2 months. Norman Rule there, the former senior U.S. intelligence official. From New York City this morning, welcome to the programme and good morning. Your equity market on the S&P 500 looks a little something like this. Negative 0.2% near session lows after the bounce yesterday on the S&P 500 and on the Nasdaq. Absolutely flying. If you're talking about AI, great. AMD, Alphabet, what was it, Gemini yesterday?
Yep, Gemini.
Bramo getting everyone excited. Yields up this morning, 3 basis points, 417.78. Going into a jobs report just around the corner. If you are just joining us, I'll go through the numbers again just for your benefit. 183,000 is the estimate, Tom, in our survey.
Well, it's the estimate there. It's come down. Am I right? It's come down a little bit. It was 188, I think,
popped
earlier
up to about 189. It's drifted back lower again. McKee tells me the whisper number is a little bit lower than that.
Yeah, and the screen, put it up right now on the screen, Amy, if you can. I know you guys are having donuts, but put up the screen here that's got all the different firms, non-farm payrolls. On radio, this distribution is, well, that's not what I wanted, but I'll go with that. Payrolls, there it is. Goldman Sachs, 238. Deutsche Bank, 130, John. There's a point of disagreement here.
Actually, looking at the whisper number now, Tom, it's ticked higher again. So we're about 200K
I did
the
not
whisper
know that.
number.
Okay.
Yeah,
We're learning by the minute here,
whisper.
1 hour away.
Never really understood that. People just type in their number on the Bloomberg terminal.
People give you a sense they inflected higher, but they don't want to put their firm's name behind it. So
got it.
that's
because
kind
it
of
was
the idea.
lower. Yeah.
It's,
All right, cool.
moving target.
Okay.
Good fun, guys. Thanks.
Joining us now, the whisperer of Washington, Amory Horton joins us, Bloomberg Washington correspondent. Here in the festive season at hand, Amory, I'm going to cut to the chase. There's nothing festive this weekend in the Eastern Mediterranean, really from the far north on down into a stressful Egypt as well. What will be Mr. Biden's approach this weekend to what we see in Gaza?
Well, today the president is heading off to Los Angeles. He's really ramping up on his fundraisers as he looks ahead to next year and the presidential election. But obviously, there's a tremendous amount of pressure on him and this administration when it comes to what we're seeing in Gaza. Just this morning, you heard from the director of the UN agency that works with Palestinian refugees, just talking about absolute wild streets in Gaza, civil order breaking down. And Norm Raoul was pointing to a lot of this earlier in your program about the effect and the humanitarian issues happening in southern Gaza. So this is going to become a big issue today for Secretary Blinken, because you have a number of Arab foreign ministers here in the United States, like Prince Faisal of Saudi Arabia, the Qatari foreign minister. They are here to talk about the situation in Gaza, and I imagine there's going to be a tremendous amount of pressure in those meetings with Secretary Blinken.
We are not hearing from the Secretary of Defense. I look at all the different newspapers, the ones you look at every day, and it's Blinken, 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 Blinken. What does the Secretary of Defense say?
Well, we heard from him last weekend, though, when he was speaking, and he talked about the fact that he wants to make sure that what Israel does is complying with international law, and he pretty much put a warning out there. Then you had Senator Lindsey Graham call him naive for this, because he said that we should not turn a strategic win into a strategic defeat. And he was talking about the center of Palestinian civilians and driving them into the arms of extremist groups. That was his warning. And, you know, you're dealing with a situation now that has become incredibly difficult. If the Israelis are trying to go after, and they are, Hamas leaders in the south, well, the south of Gaza is where they told Palestinians in the north to flee. So on a humanitarian front, this is incredibly challenging, and the death toll continues to rise every single day.
How is it affecting the poll numbers for President Biden at this point? I mean, we know that it went down significantly, but has it evolved since then?
Well, you know, I think there still needs to be more work done on this polling, you know, because we have to see how this plays out. We do know that the president is suffering in the poll numbers when it comes to the youth vote, and obviously a lot of reports about Palestinian Americans, Muslim Americans who do not like how this is being conducted from the Israeli side. We also had 5 Democrats yesterday come out and talk about the fact that they want to see more being done on aid, U.S. aid that's being sent to Israel, to make sure how that aid is being conducted, how those U.S. missiles are being used. So there's a tremendous amount of pressure on this administration. I think we've talked about it a lot in this program as well. Even within the administration, there's a lot of individuals, not in the top brass of the State Department, but a little bit on the lower level, who also don't agree with the U.S. policy.
I have to say, Anne-Marie, just to shift gears a little bit, I've been really fascinated by what can actually get done in the House in particular as we deal with some very real issues, whether it's some of the conflicts that you're talking about internally over aid to Israel, aid to Ukraine. We've talked about that border security. Punchbowl came out, they're workshopping this one. They said that there is an infamous do-nothing Congress of the 1940s, and then they said, what do you call this year? Do-nothingist Congress, the less-than-nothing Congress, the zero Congress, the Congress that just is completely unworkable. Anne-Marie, is there any hope that that will change next year?
No, there's no hope that will change. I think next year potentially gets worse. The numbers even get tighter for the Republicans on the House side. They ousted the representative from the New York 3rd Congressional District, George Santos. Of course, we know the Speaker, Kevin McCarthy, is retiring at the end of this year. And they have a number of deadlines. The first, of course, being early in January for another potential government leading up to a potential government shutdown. They're trying to get the supplemental package done. I really would, instead of looking at the House right now, because next week the House is also focused on trying to impeach President Biden or starting up that formal inquiry into that. Look at the Senate. That's where the deal is going to get struck when it comes to this supplemental package. And right now, all the tension is about border policy. Republicans want to see more, not just funds to the border, harder asylum process, stricter parole. Democrats want to make sure they're doing this in a compassionate way when it comes to individuals looking for asylum and refuge in the United States. This is where the fight is right now, and that deal will get struck in the Senate.
How alone is Senator McConnell?
Well, I don't know if he's very much alone. He's going to want to also see stricter border policy. I mean, this is also showing up in the polls. But he is a hawk when it comes to the defense policy. I mean, he's been talking about for months that we should be sending aid to Ukraine. The White House put out a statement this week from Shalanda Young talking about the fact that there is not a pot of money at the end of the year. It all dries up. And in that sense, his colleagues have not heeded his advice just yet. But there still is time. But, you know, a lot of people I talk to says this bleeds right into February.
AMH, thank you. Anne-Marie, down in Washington, D.C. Let's talk about December before we get to February. January, February in Washington is going to be ugly, by the way. The fighting over spending cuts, huge.
Yeah, you
massive.
had the 2 dates yesterday, January 19
nuts.
and 22.
And then into February as well,
like
yeah.
that, yeah.
I want to go back to the whisper number just quickly. Update, 175, Bramo. 175. Been climbing all through the month of December. Off the back of the data we've had this week as well.
I mean, just to show that early in December they were talking about 150 and they've just been edging it higher, to me highlights how much people have been surprised by the continuing strength. We talk about bad news is bad news, good news is good news. So far we've gotten good news and it's actually been treated as good news. And I think that that's really what we would hear from some people who are proponents of just treat news as on face value. And trade accordingly.
Can you imagine if you tuned into this show on accident and listened to this?
No, I'm sorry. To anyone who has, I apologize. From every point of view.
About 10 minutes ago, 15 minutes ago, was talking about anything 100K or below would be treated as bad news for this market. And I think she's probably right.
100%, because if you back out 40,000 from the strikes and then you back out the government hires, all of a sudden it's almost negative or almost no pay growth.
Do you know, once I got the poll right, you know, they do like silly 8:30
People
polls.
don't do job guesses anymore.
Once I got it right, I've never done it since then. I figured it was such blind luck.
What year was that?
It was a million years ago. I think, you know, Nixon was president.
We used to do that. The whole newsroom would erupt.
They would erupt?
Yeah, when the number came out.
Oh, right, okay.
It would be a real dramatic moment.
It's exciting.
Yeah, yeah.
60 minutes away from the payrolls report. The scores look like this on the S&P 500. Pulling back just a touch. We're down 0.1% on the S&P. The Nasdaq with a decent bounce yesterday. Best day of the month so far on the Nasdaq 100. Yes. This morning we're negative 0.25% TK on the Nasdaq. The beating heart of this market over the last month or so, the bond market, a rip-roaring rally. Yields lower, much, much lower. This morning a touch higher by 2 or 3 basis points, 417.78 on a 2-year. What a turnaround, Lisa. Last time we played this game going into payrolls, yields near 5%. This morning 462.46.
And the conversation used to be what the threshold was to raise rates again. Now the threshold is how far do they have to go? How quickly can they just cut rates extremely quickly? I mean, this to me is just sort of the way that the narrative has shifted. Everyone's just saying how many cuts, not will they raise again.
And not just the Federal Reserve, the ECB as well. Let's look at that currency pair, the euro against the US dollar. The euro right now at 107.84.
No.
The ECB, according to most people, they're going to go first, Tom.
I don't
and
buy
maybe
it, but I agree.
they're going to go harder.
It's in the zeitgeist, no question about it. And somebody, was it Jeff Yu that had the call through parity?
Parity. Matt Hornback yesterday, Morgan Stanley. He's looking for a stronger US dollar.
We're distracted.
And maybe
we're
testing parity.
We're looking at Japan.
We'll keep talking over each other. It works. It's good.
It works. It's good.
You want me to get it on the game?
John, it's simple here. This is a big deal. This is a big deal on ECB.
I'm with you. 150 basis points to call it Deutsche Bank. And Lisa, largely priced now.
Yeah, although at a certain point you have to wonder how much pain they have to experience. We are seeing a bit of a stabilization, and will that be enough for them to cut as much as they are?
I think we've had enough of this market check, haven't we?
It was
Your
brilliant.
top stories today, under surveillance. An hour away from the November payrolls report. Bloomberg's median estimate calling for a gain of 183,000 jobs. Wall Street's biggest banks coming in with a wide range of forecasts. Lisa, Deutsche Bank at the low end, looking for 130. Goldman at the top end, looking for 238. We mentioned Ian Shepperson at Pantheon Macroeconomics, looking for, drumroll, 275.
Yeah, I think when you back it out, the question's going to be how much is wage growth? That was what Priya was focused on. How much are we seeing the unemployment rate rise or stay stable? And I'm watching hours worked, because that also will give you a sense of just where people are starting to pair around the markets.
You got to pick up the CPI report next week. I took a look at the calendar next week, and you know, this is a big deal, and at 8:31, the world's going to change. But OMG, put it together with the data next week, including retail sales after the Fed meeting.
Yeah.
We're going to have a real snapshot of where we are.
Three-part
here in 6,
act.
7, 8 days.
Tons of economic data.
Yeah.
The Federal Reserve
No question about
next Wednesday. We're talking about cuts at the Fed, cuts at the ECB, and maybe hikes at the BOJ. Expected to end its era of negative rates this spring. More than 2/3 of economists polled by Bloomberg see the BOJ raising into positive territory in April. Traders and economists boosting their bets after a meeting between Governor Ueda and Japanese Prime Minister Kishida. The yen rallying the most in nearly a year before pulling back in yesterday's session. The next meeting, TK, for the BOJ, December 19.
Huge deal. And the other deal here is the culture of it. And Robert Feldman of Morgan Stanley in Tokyo, and the whole Morgan Stanley team is who I read first. There's others. Credit Suisse had a great team there before the blow up with UBS. But to me, it's also about Japan, the people, the demographics. And the fact is they're living 3% inflation, and that's undoable psychologically in Japan.
Yeah, 3 to them is like what here? Double digits.
My amateur take would be a solid 5%.
Crazy.
Crazy.
Amazing to see. And amazing to see the guidance that we're getting from the BOJ, Bramo, where they start to say things like it's going to get difficult towards the end of the year and the start of the year to conduct monetary policy.
Which is the reason why people are talking about abandoning it. The one complicating factor is that the economy is suddenly not doing that well. And there was data that came out overnight that the Japanese economy contracted in the third quarter at the fastest pace, going back to the depths of the pandemic. So it's sort of, are they going to be overcome by events in the opposite direction where they're not going to be able to move away? Because yes, you are getting inflation, but it's not being accompanied with the same growth that they're looking for.
Dolly Ann with a massive move in yesterday's session. Let's finish on this story. The US and the Palestinian Authority working together on a post-war plan for Gaza. The Palestinian Prime Minister telling Bloomberg the preferred outcome would be for Hamas to become a junior partner under the Palestine Liberation Organization and to build a new independent state, Tom, that includes the West Bank, Gaza and East Jerusalem. The Israeli Prime Minister Benjamin Netanyahu vowing to eliminate Hamas as the campaign expands in the south of Gaza.
I'm going to go to Mark Kimmett, General Kimmett, who has been a great font of wisdom for Bloomberg surveillance, and he talks about urban combat, hand-to-hand combat. It's a hand-to-hand combat weekend there. I don't care about all the punditry, all the diplomacy in that. Where are we in this war and battle Monday morning?
Ongoing
all that matters.
And increasingly difficult.
Yeah.
That's the story.
All that matters. An email in, Robert, thank you so much. This guy's emailing in from a goalie camp up in Toronto. Robert emails in, John, what do we do with this? Bearish joining Team Lisa.
Didn't most people join Team Lisa?
I think you're right.
It's a big team.
No one's on Team Tom.
It's a big team. And then they sort of ran away in November very quickly.
Is there a Team John?
What is Team John?
I don't know.
It's a lonely place.
Everybody's on Team Lisa.
We're just a pessimistic place. We sit around and just worry.
Yeah.
It's, it's a cultural
thing.
Team
Lisa.
Fun. It's literally family lore.
Yeah. Are you going to, we've had Sarah Wolf here.
We have.
With us, we're counting down to the jobs report, and she joins us. Team Sarah joins us with Team Ellen at Morgan Stanley. You people do hyper-accurate consumer economics. What's the state of 70% of the economy into this jobs report?
Consumer spending is slowing down. It's not falling off a cliff, but we're definitely seeing that down step in the pace of consumer spending going into the fourth quarter. We got an early read on holiday shopping, Black Friday. Sluggish, but as expected. We know that e-commerce was stronger, but you definitely had a consumer looking for discounting, more pressure for the lower middle income household. And we expect more of that slowdown to come next year as you get more of that pressure from higher interest rates, tighter lending standards, and a slowing labor market.
Buy now, pay later. Absolutely booming. What are you and the team saying about that?
Buy now, pay later is having a very large take-up rate, in particular for Gen Z, younger borrowers. The overall share of the credit market is still very small, so it's not as big of a macro problem. But I do think it's showing that, the demand for credit is slowing, the availability for credit is slowing. So households are having to lean more on BNPL, and this is more available to the lower income borrower.
Do we have space to lever up in households in America?
Households actually do have space to lever up. Debt service costs are still near record lows. They've barely moved up, in particular because 90% of household debt is locked in at a fixed rate. And we know nobody's buying and selling homes. So we're actually seeing that households are not super levered.
I just want to say this is the heart and soul of Zentner economics that Sarah Wolf's talking about here, John. Everybody's hysterical about consumer debt and all that. And I think we just heard we shouldn't be hysterical, right?
I would agree with that. I think that we're seeing pressure on the consumer, but interest rates are 5.5%. We've been in an aggressive hiking cycle. We should be seeing pressure on the consumer, but I don't think we need to go off and say that the consumer's falling off a cliff because we're seeing some rise in delinquencies and some pressure on the credit space.
We were hearing from Abilo Faruqi, and we heard something similar from Priya Misra, that the longer things look pretty good and there aren't that many warning signs, the more likely a hard landing is. Do you agree with that?
Of course, the longer that rates are high, the more that these uncertain lags start to play out, and it makes the Fed's job harder and harder. Of course, they're in a really difficult position going into next year. Markets are pushing on for a March cut, but the inflation data is not going to feel comfortable enough for them to do so. So even as economic activity is slowing and the labor market's cooling, we think the inflation data is going to push them to stay on hold all till June.
Which is the reason why Torsten Slok of Apollo came out this morning and said the market is underestimating the Fed's commitment to 2% inflation. This is what we're hearing from guest after guest after guest. Where is the potential biggest market disruption? Where is the market most mispriced to what you and so many others say is the reality, which is the Fed is not going to cut rates aggressively come the first quarter of next year?
We think they're mispriced for March. Chair Powell is looking at the 3-month, the 6-month, the 12-month annualized pace. He specifically said the 6-month annualized pace of core PC inflation is 2.5%. I mean, that's a lot of progress. But if you look at the path ahead in the next 3 months, core PCE 6-month annualized pace is actually going to be accelerating. And then it's not till the second quarter that it starts to fall again. So we're going to start to get that data of core PCE picking back up again. And we think that could push out March pricing further out.
Well, picking up by 0.1%, or is it a demonstrable pickup that's going to upset our viewers and listeners?
Well, it's 2.5% right now. In the coming months, it's going to rise back above 3% because you have those negative airfare prints from early in the year falling out of the mix, and so that puts upward pressure. You have some upward pressure on car insurance. So we're going to need to get till April to get it back down to 2.5% again.
So, I was just reading David Rosenberg, actually, Sarah, and this is exactly it. There are single items within the inflation report that are going to push up the mother of all Jerome Powell inflation statistics 0.5 percentage point. Airfare, car insurance.
We're going to have to look through the noise, but it's all going to matter. There's going to be a lot of focus on core services ex housing, a lot of focus on housing itself, which should continue to moderate. But you have to pay attention to the totality of what's going on in the inflation data, and it's going to be picking back up again in the coming months.
3-part story Wednesday. So statement, projections, news conference. Can you give us the guide for Wednesday?
Yeah, we're expecting very little change in the statement, but we are expecting for Powell to cautiously change his communication from how high to how long via the summary of economic projections and also through the press conference. What do I mean by that? Well, of course, they're going to be taking a dot down for this year, and we think they're going to show 75 basis points in cuts next year because inflation's looking better. They're going to have to mark down inflation to 3.5% this year, 20 basis points lower next year. So they're going to show a more dovish path, but he's going to have to keep pushing back that they're not yet talking about easing policy. He said it at Spelman last week. It's too early.
Except they are, because it's in the 24 dot. Does the 24 dot compromise his communication in the news conference on Wednesday?
It's still above market pricing, 75 basis points in cuts, so it'd still be pushing back against the, 5 cuts that are priced in for markets right now. But it does make his job very difficult, where we've seen over 100 basis points in easing in financial conditions since the November meeting. Markets are really getting ahead of themselves, so he's going to have to be a little bit more explicit in his communication that it's too soon to be talking about cuts.
Which is the reason why I find it fascinating, the question, has the Fed already lost its credibility? Because he tried to push back, and the market just said, we're not having it.
The Fed's doing the best they can in a complicated environment, aren't we all?
So diplomatic. That's beautiful. Almost rehearsed, Sarah, that was. Do you like that, TK?
I was rehearsed.
Chairman Powell's doing the best he can, Bramo. Look, at some point, doesn't the market always test the Federal Reserve when it gets to this point?
They always test the Federal Reserve, and the Fed is trying to figure it out. But there's a lot of time between now and March, and there's even more time between now and June. As you said yourself, we have jobs, we have inflation, we have retail sales. I mean, we have a tremendous amount of data that could definitely move markets in the next week.
Mohammed Al-Arian thinks it's a communication problem, a credibility issue. We'll catch up with Mohammed in the next couple of hours. No, it's what they're saying and what isn't happening in markets. They're pushing back, but getting... Look, last Friday, the chairman got absolutely steamrolled. If that was pushback, Bramo, this market just laughed in his face and rallied really hard.
Well, I think that's exactly it. I mean, it was almost like a mockery because he was saying one thing and the market was like, oh, that's the best you got? Give me a break. You could have been so much harsher against the market move. The question is, do they care? Do they care that market conditions have eased? To me, that's a bigger question. If they don't care and he's not going to be that much harder in his communication, does that send a message in and of itself?
To put a number on that, and it's stunning, the Bloomberg Financial Conditions Index, the Goldman Sachs one's fine too, positive 0.56, and the answer is it's more accommodative, and the answer is they do care. It's plain and simple. It's moving away from the zero number substantially.
Sarah, thank you. It's good to see you.
Thanks for having me.
Hey, thanks for the guidebook for next week as well. Sarah Wolf there of Morgan Stanley. If you are just joining us, welcome to the programme. Equity futures, negative 0.1%. Similar story in the FX market, the euro, negative 0.1%. In the bond market, yields higher by 3 basis points, 4.1816. And the most confusing story of the week, crude. Back in the 70s, Lisa up 2%, $70 and about 74 cents.
So the why behind this, I was reading, and I actually find this really interesting, even though they're incremental moves every day. But now the speculation is that Saudi Arabia, when they met with Vladimir Putin, who evidently is running for re-election again, I wonder who's going to win. But there's this question of whether that he's cooperating more with Saudi Arabia.
Who is going to win?
I don't know.
Fascinating
Vladimir
stuff.
Putin
Can you bet on
versus
that?
who?
Can you bet on that?
Well, sure.
No,
I
probably
don't know.
not.
If you take us up, pick you up.
Where do you see the debate?
Probably not. Yeah, it would be a great debate. Any challenges, TK?
I steer clear. I'm not read in on it. I defer to Emery
That's
Horton
a
and
very good way of
Henry Winter.
That's a very good way of getting around that.
Or Moscow
We talked about airfares. I want to talk about airlines. Earlier on this week, global airlines poised to generate record revenue this year and will extend the gains into 2024. The turnaround, Tom, for this industry.
Turnaround's there, but I wonder where the profit is. They're better managed as a generalization than they used to be. They're making profit, but you and I've noticed the stocks haven't responded. They're not to pandemic lows. They've come up a little bit, but are they booming? No.
We're off the highs of July.
Yeah.
Airfares, fuel costs, all of that part of this story. More still to come on that. Bloomberg's Brooks Sutherland on airlines and demand heading into the holiday season from New York. This is Bloomberg.
I think this is probably the last time I'll talk about recovery, because we're effectively back to where we were in 2019. Always challenging with the general macroeconomic environment, but actually we remain cautiously optimistic about 2024. And I think the recovery we've seen in 2023 has been very encouraging and should give the industry reason for optimism next year.
That was the IATA Director General Willie Walsh. JetBlue also boosting its 23 outlook, citing better than expected bookings and operational performance this fall. The improved forecast coming after Delta's president signaled strong demand heading into the end of the year. JetBlue over the last 3 months, Tom, picking up just a little bit.
You think fuel's into it? I mean, you think,
Big part of it.
we have a panic here when the price of oil goes up and all that, but now the price is down. Does it really play in to the financial part of aviation?
I can only say the peak for discretionary stocks for many of them, including the airlines, Tom, was July, was early this summer. They struggled since.
I've had trouble with it. I mean, I look at the fares. I had to book a flight for one of the Offspring here in the last 24 hours, and I was shocked how inexpensive it was. It was like, economy.
We're talking like 5K instead of 8?
No, this is like a local flight. It was like, it used to be, it was $300 and then it was $700 and now it's like Middletown, not Teterboro.
Okay.
And then, the Dassault. But the answer is it's gotten cheaper, even the short little junket flights. It's amazing. I mean, it's really, really.
Things have turned around a little bit.
Yeah.
I would still say it's expensive, but sure.
Let's do the math on this. We can do the math with Brooks Sullivan of Bloomberg Opinion, expert on aviation and all the moving parts of it. Brooke, I went to the source, Google Flights, and I looked at one of the international flights that John and I look at all the time, and it used to be $7,000, and I think I even remember a pandemic $9,000, and right now it's $2,800, down from $5,300 median. This is New York to Paris. How did we get here? Why is that flight so cheap?
Well, and actually the airline CEOs are trying to argue that the transatlantic travel season is going to extend well deep into the winter. And so that price data point is certainly not in line with the philosophy they've been espousing. But to your point, part of the problem is that airlines did not have enough capacity when we came back out of the pandemic. They got really stumbled by just the sheer volume of demand, and they didn't have enough people, they didn't have enough planes, and so they overcompensated. They added back a ton of capacity, and it's not like demand has fallen off a cliff for those transatlantic flights or for those domestic flights that your Offspring were taking, but there's just a lot more available seats. And airlines are having to offer discounted tickets in order to be able to fill up those seats, which creates a very dangerous dynamic for their profit margins at a time when costs are also up, not just from fuel, but also from labor.
So forget about the PR from the aviation. Let's do the Brooks Sutherland guess here. What does later 2024 look like? Are they canceling plane orders? Are they taking capacity out? How do they respond to these realities?
I would be surprised to see them cancel plane orders just because the wait times for those aircraft are so long. And if you cancel it, you're really setting yourself back years. But I do think that we need to see substantial capacity cuts. Now, we've seen a little bit, specifically in the first quarter, but this is mostly really a trimming around the edges. We have yet to see this really big capacity cut that I think the industry really needs in order to be able to level set. But I do think, that time is going to come because they're banking on a return in corporate travel that just has not materialized yet. We thought we were going to see it in the fall as more companies push people back into their offices. That did not end up playing out. If you don't have those corporate travelers, the airlines are very dependent on leisure markets where the capacity problem is really stark.
On the other hand, how much of a boom is it, some of these airlines, that gas prices have gone down as much as they have?
It definitely helps. I mean, fuel is one of the biggest costs for airlines outside of labor. And to see these prices coming down is definitely a boost. But I do think you have to wonder if you can bank on that. Fuel prices tend to be a volatile metric. I don't know if I would want to build my whole business around that.
There is this question also about the signal from airlines in the industry. We've been talking about how can you be calling for a recession when you have record demand, albeit maybe not as much as they were hoping for, but still incredible amounts of travel. Thanksgiving was booming, levels seen really that were at records, even including pre-pandemic times. Is it just a matter of expectations being even higher, or are we actually seeing some sort of softening in demand?
It's interesting because there was weakness over the summer on those domestic routes. And what the airlines said is that people were pivoting and that they were traveling internationally instead because those markets were much more open than they had been at any other point in the post-pandemic period. Now I think the pressure is really going to be on to see if people continue to take those international trips. I personally am skeptical. I think if you were a family, you went to Europe in 2022 or 2023, do you need to go back next summer? I don't think the answer is yes for a lot of these families. And I think we're going to start to see some pressure on the consumer when it comes to travel. We're already seeing it on big ticket items, things like lawnmowers, washing machines, motorcycles. I think that eventually extends to international travel and domestic travel.
Brooke, to your Kansas heritage, which is where aviation is centered. Sorry, folks, not the Carolinas. It's Kansas, Kansas, Kansas. What do you perceive as the future difference in engineering between Boeing and Airbus? Boeing is wicked traditional, wicked manual computers. Airbus is more fancy computers, fly-by-wire is what the adults like you call it. Where are they in 5 years? Do you feel like one of them will radically change, or are they set in their ways?
I think 5 years is a short time horizon. Both of them are trying to think about what the next generation technology looks like in terms of reducing carbon emissions from aircraft. Airbus is experimenting with interesting hydrogen technologies, whereas Boeing is really betting on sustainable aviation fuel, and they have a couple of other projects. So they are taking different paths, but the goal is really, how do we make these planes more fuel efficient? That is what is going to be the driver for the next generation of aircraft, because sort of incremental improvements from engine technologies is just really not going to get you there or be a motivator for these airlines. And so as Boeing and Airbus think about what their future pipeline looks like, that's really their priority.
So they're going to go down to one engine. I can see it now. Brooke, what?
Or maybe no pilots. I don't know. We'll see.
Yeah, well, that's not funny. I mean, the idea here that we're down to 2 engines on a 777, I mean, where does the efficiency come from?
Well, I think I would argue that we're really pushing the efficiency limits of the engine technologies that we already have. When you look at the quote unquote teething issues that these engines have had, whether it's, the LEAP engine from CFM, the GTF from RTX, which has had particularly acute problems. Rolls-Royce has had issues of its own with its engines. I think we're really pushing the bounds of this technology in terms of what it can do. And so to really make a quantum leap forward in terms of fuel efficiency, carbon emissions, we're going to need some different technology. And what that looks like, I don't think the industry is actually settled on yet. They're pursuing a number of different paths. and testing out different options.
Hey, Brooke, you're awesome. Love hearing from you. Brooke Sutherland there of Bloomberg. Thank you. Let's turn to the payrolls report. It is 36 minutes away. Neil Dutta of Renmark just publishing. Want to share with you just a couple of lines from Neil this morning. I continue to see some analysts noting that the threshold to cut rates is high because the Fed wants to be very sure about inflation slowing down before they ease policy. I don't get it. Goes on to say, the threshold is conditional on the inflation outlook, and the threshold for price moderation in the months ahead is not very high. For the likes of Neil, Tom, many others as well, the disinflation that's in the pipeline right now, it's already baked in. You're going to see it in the next few months.
As an almost inertial force, David Rosenberg seconds the motion with Neil Dutta this morning saying, look, this is the trend, get used to it. And what's fascinating, Jim Bianco was quite articulate on this in the last 24 hours, and he was way out front with the idea of leveling inflation, or even up, as we heard from Morgan Stanley and Sarah Wolf. That's sort of into the weekend. That's where the debate's engaged.
What I love about Neil Dutta is that he watches the show and listens to the consensus call and then writes in hate mail basically saying they're all wrong and this is the reason why they're wrong. They think that the threshold is higher than people expect. I think it's not. I think it's even lower. I love that. It creates the real dialogue that's on Wall Street.
Well, he's been right.
He has been right.
2024.
To be clear, we get a few more people
that
write in that say they're
I'm sure
wrong.
he feels right about 24 as well.
Right now, yes.
Can I ask a question? The wonderful conversation with Brooke
Please do,
Sutherland. Have you ever flown the ginormous Airbus plane? I've never.
Which one is that?
The A380, the one you're at Heathrow, and there's this thing next to you that's twice the size of a Boeing 747. Have you flown it?
I don't think so, no.
I've never flown it. I've flown a lot, and I've never flown it by chance.
Would you like to?
It's like twice the size of a Boeing 747.
Would you like to?
I don't know. I just
I'm just
like a
wondering
dinosaur.
why we're talking about this.
I think it's gorgeous engineering, as Brooke talked about. And
do you like it when there are 5 seats together in the middle?
No.
You think he sits in the cabin with 5 seats together in the middle?
Sorry, you're right.
What are you talking about?
Okay, all right, fine.
You don't
I'm
even know what that looks like.
Okay. There's like 3 and there's 5.
Payrolls 34 minutes away.
God.
TK hasn't turned right on a plane for about 50 years. Nadia Lovell of UBS is coming up next from New York City. This is Bloomberg.
We still have more and more evidence pointing in the direction of the labor market softening.
I think there is still some underlying strength in the labor market.
Job growth is strong. It has decelerated a bit.
Labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
You'll get a bigger reaction with a weak number. I think a strong number is largely priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on Jobs Day, on radio, on television, across the nation, and worldwide. Where will we be at 8:31? Forget about 8:30. I'm interested in 8:31. And the market reaction here, the whisper number says maybe a little weaker than what the published numbers
You've
are.
set this up for the conversation you really don't like, so we're going to have the conversation you really don't like. The estimate in the survey is 183,000. What you're basically asking is bad news, bad news.
Here we go, please.
If it's 100K. I think that's going to be the really interesting thing, Tom. It's bad news, bad news. Is there a point at which this number comes in below estimates where people start to sit there and go, oh, that's bad, but it's really bad? Because not all rate cuts are created equally. That's the issue that I have at the moment.
Yep.
If they are the Neil Dutta surgical rate cuts off the back of the disinflation we're all expecting going into New Year, great, so long as growth is robust. But if you get that economic downturn, that's a different kind of rate
Swing
cut.
it the other way. Ian Shepherdson, 250, 260, 270 goes the other way, John. I mean, I'm sorry. That's going to be a shock to the market as well.
Upside surprise, which tees up this one. Bramo is good news. Good news.
Well, I think that it depends which aspect of the news. As you guys were talking about the headline figure, I thought to myself, does it matter if the hours worked go down significantly? If what you're seeing in terms of the quits is it's going down, if the job openings is also coming down, if these other indicators are showing a softening at a pretty big pace, can we get a read-through at a time where there are distortions from the UAW strike, from government hiring, from medical hiring, from other things that were already in the pipeline?
I don't want to take a lot of time here, but the difference in the two GDP measurements of GDP versus GDI, all you got to know is they don't match. what are the revisions going to look like? Do we have any idea of the veracity of the last two jobs reports, October and September? I don't think we do.
And then we've got CPI. And then you've got the Fed, and to your point, then you've got retail sales. I'll go back to something we talked about a month ago. So for the Neil Dutters of this world, this labour market is no longer a reason to be hawkish. And Lisa, what you and I have been talking about now for months, at what point does that tip and starts to become a reason to be bearish? Is it still too early? Based on what we're seeing in jobless claims, possibly it is still too early to expect that.
Especially if you believe in the Priya-Misra idea, which is that services-side inflation tends to be stickier, and that's going to be concerning. We also heard that from Torsten Slok over at Apollo, where he said people are underestimating the Fed's commitment to getting down to 2%, including that last leg, which is much more difficult.
Tough meeting for Chairman Powell, next week. Really difficult.
And more difficult just in the last 2 weeks.
Yeah.
Yeah, with the market moving.
The market is pricing 100 basis point plus of cuts next year. And they've got to put in some dots for where they think rates are going to be in 24 and beyond. Tom, that's going to be difficult to do.
26 minutes away, we're going to do a longer data check here to set you up as we go into Nadia Lovell and into the jobs report. John, the VIX 13.13. I think that says bull market in a 16,000 NASDAQ 100 level. I think that says bull market.
Up 45% year to date after the move yesterday on the NASDAQ 100. That is just absolutely ridiculous. And more ridiculous when you think about what people were looking for at the start of the year. Tech's on its knees and people are just kind of beating it up. It's not going to get any better. And then we absolutely ripped Bremo off the back of the AI story that dominated NVIDIA and now Alphabet and now AMD, take your pick.
And nobody's willing to really push back heading into 2024.
You get
if you notice,
steamrolled.
Yeah, well, exactly. But what I find interesting is there's a change in rhetoric. It's not, oh, tech is going to lose value. It's tech might not outperform as much going into the later months when you start to get a broadening out in the market rally. Basically, don't bet against tech, and everyone is petrified of that. You can feel that in all the outlets.
That's stocks. Here's bonds. 2-year up 3 basis points, 463. 10-year Tom up 3, 418.
And where are we from 30 days ago? I mean, John, you and I were talking about it at sometime, I think, when we had our 5:58 meeting to get ready for the show.
It's always a good meeting, yeah.
Yeah, it is. You take a minute to get ready. And the answer is a 2-year yield from a 4.99 the day before the jobs report last time down to 4.62. I mean, this is the kind of scale.
Big turnaround. Does the data validate it? Yeah. We've seen those disinflationary trends. Does the data validate it?
We're going to do that with economics and with Michael McKee here coming up right now on this equity market. Nadia Lovell briefs always senior U.S. equity strategist at UBS Global Wealth. I think, Nadia, we're almost beyond the idea of is this a bull market? I guess it is. Is it a bull market with breadth and widening breadth into 2024?
I mean, we think so, that, the market breadth will continue to widen out. But we do think that some of the leaders from this year will continue to be leaders for next year. But again, a lot of this is just going to remain on the data. And to get this out of the way, we know we've sort of been in this market of rotating narrative. And it does feel like on the growth front, we're probably back into that, too good news is bad news. Too much of a good news is bad news. And bad news is just bad news, just given how much rate cuts are priced into the market at this point. But this is temporary and it could create some volatility. We think that ultimately, if the macro data continues to support a soft landing, that this market can move higher from here. And I think this past week, we've had some interesting and encouraging commentary from many industry conferences, including tech, financials, and consumers. And companies aren't really seeing any slowdown right now. The consumer remains resilient. They continue to point to that. And so that should continue to support this market into 2024 and cause a burden out.
Let's pick out two sectors that I know you like, Nadia, and good morning to you. One is tech, the other is energy. Let's start with tech. The winners are 24. Are they the winners of 23?
Yes, we think that tech will continue to outperform and that performance will broaden out. Obviously, we know that the AI enthusiasm still remains and is alive and well. We saw that yesterday. We continue to see adoption increase and also, monetization increase. And we know that there's still a leader in AI chip makers, but, that's also broadening out and the others aren't standing still. And we're also seeing others produce alternatives and really broadening out that field. But I will say that our view on tech isn't solely about AI. Yes, AI revenues are rapidly increases, but on a relative basis, they're still relatively small in the overall sector. This is more about improving fundamentals in the rest of tech. You're starting to see cloud optimization come to an end. You're also starting to see, previously depressed end markets and semis improve and are at the cusp of a new growth cycle, particularly when you look at smartphones and PCs. So when we look into 2024, this is a sector that could see twice as much revenue and earnings growth as the broader market with margin expansions. And so that's why we think that at the core that tech can continue to outperform next year.
That's tech. Let's do energy. So here's the struggle, and you know it. We dropped into the 60s on WTI this week, Nadia. I know that you and the team have been looking for 90 on Brent. What do you think is going on in the commodity market?
Look, it is totally understandable why the market lacks confidence in oil prices right now, just given the confusion around the OPEC Plus meeting last week, and the fact that the cuts into the incremental cuts into 2024 in the first quarter is voluntary. But given where oil prices are right now, we do think that likely increased the commitment from OPEC Plus, and you could see high compliance for that over 2 million barrels a day cut in the first quarter of next year. But of course, near-term volatility is going to remain just given the systematic selling that's going on. But we think that the demand picture remains intact. We're still looking for 1 million barrels a day growth in demand for next year, led by, emerging markets. Oil demand products remain strong, particularly on the jet fuel standpoint. So some patience is required, but we still think that this market will be in deficit in the first half of the year. And we think that Brent oil can get back to $90.
Patience versus adding to the bet. Which is it when you look at Exxon shares that are down more than 17% since the end of September?
What we've been saying to clients who don't already have an overweight to energy, we said that this is an opportunity to add exposure because we think that these levels, that there's limited downside from here. We think that OPEC will continue to step in to support oil prices. Yes, we had expected last week to be a clearing event. But when you also look at these companies fundamentally are in great shape, strong balance sheet, do a lot of free cash flow generation, and returning that cash to shareholders through massive buybacks and dividends. And so we think that there is an opportunity here to add to energy for those who aren't already overweight.
I want to end where we began, where you basically came out and said that pretty much everything will be bad news that we get, even if it's good news, because if it's not Goldilocks with respect to the labor market report that we get in about 20 minutes time. What does that mean in terms of how you are going to position on the heels of this? In other words, are you going to use it as an excuse to sell, or are you going to use it as an excuse to buy into strength that you expect at the end of next year?
We will be surprised to see, any weakness in the labor market near terms, just given how some of the other data are coming in. And the last three labor market reports have been encouraging for the market. But again, expectations are high given the number of rate cuts that are priced in for next year. And so if we see sort of, payrolls that remains in the high 100,000, to 200,000, we think that is an opportunity to continue to remain in the market. If you start to see something, in the low 100,000s or below that, it does give a reason to pause and question whether there is continued resiliency in the labor market and what that means for the consumer. But ultimately, we think that the numbers will be fine. But this is a market that is on edge and will remain on edge and remain very much data dependent on what's going on in the macro.
Nadia, thank you for the update and love catching up with you every Payrolls Friday. Nadia Lovell there of UBS Global Wealth Management. It's the second time we've heard that in the last hour. They're from Nadia Lovell of UBS, earlier from Priya Misra over at JP Morgan Asset Management. 100K or below, Tom, is the number that would spook this market.
It's a round number, and I'll agree with that, 110, 120. Who knows? Dan Ives publishing out on Twitter, and with a really smart note talking about stock selection, and Nadia's call and blending in indexes and the strategy babble of, the bigger view. I would suggest 2024, typically in a bull market, 30% do well and 70%, it's like baseball, don't do all that well. And I think Dan Ives is onto something. The winners of AI, the winners in aerospace with Brooks Sutherland, it's going to be very selective.
Are you into baseball again?
I'm into baseball because the dreaded Yankees just made the trade of the year. I mean, it makes all.
Is Soto that good?
Oh yeah, he is the most patient batter in decades. The game is totally different when he steps into the plate. Totally different.
What would happen if they managed to convince Ohtani to come to New York as well.
The food sucks at Yankee Stadium, and I'd even go.
You know what? The food does suck at Yankee Stadium.
It does.
What is that about?
I don't know.
You know where it's good?
Where's
City
it good?
Field.
It's actually good.
Mets is way better. Yeah, no, it is.
Yankee Stadium
No, it is.
better.
Mets is
You
way
get a
better.
soda, and then they put these chicken wings around the side of it.
Yeah,
I see people
it's
dipping the
gross.
fried chicken in the soda.
Yeah.
You seen that?
And then there are people who are selling Ozempic right next door.
It should be.
You know, what's amazing is at Tottenham, people are there with the little meat thingy.
Tom
with
takes a
fork.
knife and fork to eat the pies.
I heard about this. How'd that work out?
Unbelievable. Knife and fork to eat a pie at a football match.
I'm sorry.
Somebody yelled out, "Hey, idiot!"
You want to do that accent again?
Yeah.
No, all right.
Very, very British.
That wasn't meant to sound threatening. I'm sorry.
That's okay.
Thanks for joining us this morning. Futures lower, down 0.2%. That sounded so threatening. That was like
do that again.
That was like a
One
Guy
more time.
Ritchie movie for a moment. I'm sorry, guys.
I know,
So
no.
it just comes out sometimes. That football thuggery.
Did you see the goal yesterday where the Tots lost to Steve Major's West Ham?
I did. Kicked it against the post, got it back again. Yeah, I know.
No, but the defensive guy here, I'll give it back to the goalie. And I'm can we at least say he slipped on the grass? And I don't
think it's
we
official
can.
now. You watch more football than I do. You watch more football than I do. I didn't even watch the game yesterday. I watched the highlights.
West Ham deserved to win. There was none of this VAR malarkey.
Wait,
They
whoa.
deserved to
Did you
win.
actually watch the whole game, or did you
God,
also
no.
watch the
No,
highlights?
I watched the highlights.
Okay, so that's basically what
No, you called me and you had the game on.
No,
What
I
are you
watched
talking
the
about?
game.
You watched
Yes,
the game?
yesterday I
Okay.
watched a little. No, I watched a little bit.
No, all right, whatever.
I
Jeff Rosenberg, 8:30 a.m. Eastern Time, responding to the jobs report just around the corner. Mike Dada coming up very shortly of MKM. Very cool. The drumbeat to payrolls, about 17 minutes away.
People are really focused on a couple of things in this report. Number one, how sturdy is payroll employment growth? You're going to get some benefit of the fact that the UAW auto worker strike in the U.S. is over and people are going back to work. And then the unemployment rate. The unemployment rate's drifted up this year despite the economy being very strong because labor force growth has picked up markedly. So those are the things that people are going to focus on. Now, 1 month doesn't make a trend. So obviously the market will react to the data that we get. But I think, the general story we have is economy that's slowing, inflation coming down, Fed pretty happy with how things are going.
That was the former New York Fed President Bill Dudley looking ahead to today's jobs report, saying the Fed is pretty happy with how things are going with a pickup in growth in the labour force, rebalancing the labour force, TK, the supply side of the economy, doing better.
Yeah, where are we in the post-pandemic dynamic? And first of all, we've never been here. Back to 1921. Someone had a research report saying this is not the roaring 20s. It's not 2021, 22, and all that. But what is it, John? Where are we coming out of the pandemic? And to me, the key thing is a study of productivity. That's a new thing in the last 90
Picking up,
days.
looking at that data. Mike McKee can talk about that in a moment. I can tell you where we are right now. We are about 13 minutes away from that jobs report, and we look like this in the market. We're negative 0.2% on the S&P 500, and the number, TK, we're looking for is 183K in our survey.
To get strong over the next 45 minutes now and after the jobs report, as John Ferro mentions, Michael McKee will join us here. Jeff Rosenberg scheduled to be with us, but now we're thrilled to bring you Michael Dada, Chief Economist, Macro Strategist at Roth MKM. And Michael, this is perfect with the ambiguities that are out there. I was doing economic profanity yesterday on John Hicks and Slutsky of Moscow and the dynamics of the American economy. To me, it comes down to nominal GDP. You're expert. How quickly is our top line animal spirit imploding?
Thanks for having me on, Tom. Well, if you look at some of the tracking numbers for the fourth quarter, it looks like the expectations are running for just over 1% real GDP growth. And, with inflation, running down at 2-3%, you can do the math on that. And it looks like there's been a pretty dramatic slowdown in nominal or top line growth from Q3, which was booming, to Q4, which looks below trend. And so, we really don't know what the underlying trend is, but I think it's safe to say that it's a slowing trend. And this is what the Fed wants on the back of all the monetary tightening that they did last year and through part of this year. So the question is, do we just stop on a dime at trend growth and continue to enjoy this so-called immaculate disinflation and soft landing, or is it something more malignant that looks like a recession next year?
What kind of trend or single point signifies a slowdown? Lisa's talked a lot about 100,000 non-farm payrolls, but to you, is it 130, 100? Is it sub 100,000?
Yeah, I think it's, a little bit subjective. If the relationship between the ISM non-manufacturing survey employment index reverted to the pre-pandemic relationship with payrolls, we'd be getting about 75K in terms of payrolls. Now that's, way below the expectations of 185, 190. So that could be a bit of a shock. I think anything that's well over 200 probably injures the bond market, which has been in the throes of this big rally. So now we have 5 rate cuts baked in for next year. Tom, I'm a bit skeptical that we can have a soft landing, no recession, a double-digit earnings growth rate for the S&P 500 next year, and 5 Fed rate cuts. It would just seem that this is a little too good to be true in terms of the story that's been cooked up by many Wall Street strategists out there.
What do you think has to give?
Well, I think the business cycle is going to ultimately give here. One thing I'll be watching today is the unemployment rate. So the expectation is that we just sit there at 3.9. So we're up 0.5 from the lows of the cycle that we observed in January and in April. And it doesn't sound like much, but a 0.5 of a percentage point move is something you typically see right at the end of a business cycle or the beginning of a recession. It's not a decisive signal yet. I mean, I think on a 12-month basis, you want to see that 0.5% increase to be more confident. So we're not quite there yet. But if we continue to drift higher on the unemployment rate, to me, that would suggest that we're potentially entering a recessionary period. So not quite there yet, but we're certainly moving in what appears to be a decisive upward direction on the unemployment rate.
It tees up the so-called SARM rule. Now, Michael, I just wonder, to get away from that just for a second, how rare is it to have moves like that in unemployment and then we just stop there and don't go much higher?
It's happened one time, John, over a 6-month time frame, 0.5 without a recession in 1951. So that's the immaculate disinflation that has been priced into risk assets. But it's happened 0 times without a recession over a 9-month interval. And we were at 3.4 in January and in April. So over a 9-month interval, up 0.5 is unprecedented since the end of World War II. Without the U.S. at a cycle peak or in the very early innings of recession. And keep in mind, these payroll figures that come from a separate survey can still be positive for a while into the early months of a recession. They're revised dramatically over time, as we all know. In GDP, the same thing. So the unemployment rate in terms of a coincident to slightly lagging indicator is probably the most robust singular variable in terms of whether we're in a growth phase or a recession phase.
One of the strangest aspects about this year has been that you could get the economic call right and the market call completely wrong, or vice versa. And when you talk about the potential for a weakening in the economic cycle, I have to ask, haven't we priced that in? I mean, if you take a look at the underperformance of the Russell 2000, if you take a look at the underperformance of so many stocks outside of the Magnificent Seven, aren't we prepared for weakness?
Yeah, that's actually a great point, Lisa. I think so. The small caps have really dramatically underperformed. Some of the cyclicals have really been struggling this year, energy materials. And so the valuations there would suggest there's probably not massive downside from here. I'm a little worried about this idea of a value trap with some of the cyclicals if we do fall into an actual recession scenario. But when that's obvious, when it's a consensus view that we're in recession, that's going to be the time you want to start to be buying some of the cyclicals or the parts of the marketplace that have already been beaten up pretty badly. So that's an important point for investors to understand.
Mike, stick with us. We're going to catch up with you once the payrolls report is out. Before we drown in that, happy birthday, Mike. Michael Dada of Roth MKM. Don't we all want to look like that at 50? At 50?
It's cut and chisel.
Just so cut and chisel, suave, we might say.
It's like Paradise City or I'm looking at the Guns N' Roses poster behind him, and I'm thinking,
very good.
I'm just looking at all of the
Nice,
songs.
Bramo.
Yeah, I was
Nice.
Sweet Child of Mine, Don't Cry. These are the things in my head right now.
Very cool. News just in from Mike McKee. Breaking news. 185 is the new estimate in our survey, Mike McKee.
Yeah, can I just say I want to be 50 again? The croupier is saying place your bets right before they start spinning the roulette wheel, and we have moved up to 185. A couple more forecasts come in, and the whisper number has followed it up. We're now at 177. So it's interesting that not only do we have a higher number in terms of payroll change than perhaps Mike Darter was suggesting is justified, but Wall Street's going along with it.
Only you will know this. Is there a whisper revisions number? I mean, go back 2 months, right?
We go back 2 months, and we did see some significant downward revisions in the past, and you want to watch for that because Mike was just saying these things get revised a lot, and sometimes when you think there's a lot of strength, it disappears if we keep that trend.
How difficult is this meeting for Chairman Powell next Wednesday? How tough is this one?
Well, the meeting itself isn't hard in the sense that they can easily say we're not going to do anything, but how he frames things in the news conference when we start asking about the dot plot and the summary of economic projections.
We being you.
Yeah. That's going to be the hard part because, as many people have shown recently, the market trades completely differently at 2 o'clock when we get the statement and then from 2:30 when the chairman speaks.
So true. So true. Mike, going to stick with us to break this down for us. Coming up very shortly, Jeff Rosenberg of BlackRock on the payrolls report. Mike Darter as well of Roth MKM. The numbers look like this. The final estimate, the median estimate in our survey, 185,000. The previous read, 150K. Your equity market has been ripping. Your bond market has been rallying. Going into it, futures negative 0.1% on the S&P. In the bond market, yields drifting just a little bit higher. From New York, your jobs report up next. "20 seconds away from the payrolls report. The scores going in look like this on the S&P 500. Equity futures slightly negative by 0.2% on the S&P 500. Yields a little bit higher on a 10-year maturity, up 3 basis points. Your 10-year 4.1816. And in the FX market, the dollar a touch stronger against the euro, 107.71. We're negative 0.2%. With your jobs report, here's Mike McKee. Morning, Mike.
Morning, John. We're waiting for the numbers to drop here, and we come in a little bit higher than anticipated. Not quite as high as Mike Darter was worried about, 199, just under the 200,000 level. 199,000 jobs created during the month of November. 150 of those are in the private sector, 28,000 manufacturing jobs, and that's the rebound coming in from the UAW strike. Now, subtract 28 from 199, and you get 171, which is still higher than people had anticipated after you do that math. The unemployment rate, 3.7%. Remember, people were going to telling us we were going to go over 4? 3.7%. I'm going to obviously have to check the numbers in terms of why that happened, which we'll do in just a second, but that is a stunning number. Average hourly earnings, we haven't seen pop up yet. So we're waiting on that. Average hours, 34.4. And
we don't know the revisions yet.
And the labor force participation rate, 62.8. There seems to be an issue with the BLS website. So let's see if everybody's going through that, because we're not getting the data that we normally get.
Take a beat, Mike. Let's go through these numbers. Headline B, upside surprise, 199. Unemployment, 3.7%. The estimate, 3.9. The front end of the bond market, wakey. Yields higher, up 11 basis points, 4.71. Nothing snoozy about this bond market right now. On a 10-year, up by 10 or 11 basis points, 4.25. Getting some wage growth number. Mike McKee, month over month, 0.4%.
Yeah, that's significantly higher than anticipated and double what we saw last month. And it means that it doesn't mean anything in terms of the year over year. I guess base effects come into play, and I'm still not getting all this data, but it's 4% on a year over year basis. And so that tells us that at this point, we're still seeing the progress that you want to see in wages, and that's even with a large jobs number. The revision is in now, a net over 2 months of decline of 35,000. So we don't know which months those are apportioned to, but we do have a smaller number for the net revisions than perhaps people had anticipated.
Take the bond market move, push it through foreign exchange, stronger dollar against the euro, 107.41 in the equity market on the S&P 500. Just about session lows, just off them at the moment, negative 0.4%. But Bramo, wow, we were talking about the prospect of a downside surprise. How bad would it have to be bad news? This is good news. Jobs are better than expected, unemployment's lower than expected, participation's higher than expected, and wages are still going. We've said for a while, for Chairman Powell, that script's not going to change on Wednesday, is it, off the back of this?
He's going to have a pretty hawkish message in order to really reflect what this shows, which is a lot more strength than even the headline beat might suggest. When you take a look at that 3.7 unemployment rate, the fact that it dropped by 0.2% from the prior month is pretty surprising. That is what nobody was expecting. But the fact that hours worked also increased. Every metric of this, wage growth increased more than expected. Every metric points to a stronger labor market than pretty much everyone on Wall Street currently thought.
I agree with that totally. It's just got a gloss here, John, that I would say is very constructive. And to me, the elephant in the room is a smaller revision, is Michael McKee. I got the HP 12C out, which says 164,000. 164,000 is a Midland number, but it's a sigh of relief from the gloom that's been whispered out there with revision.
I always say 3 minutes after the payrolls report, sometimes the price action doesn't stick, but this is the early reaction. Yields up at the front end by more than 10 basis points, back through 470 on a 10-year, 425 and up 10 basis points at the moment. Mike McKee, you've been chewing over the numbers. What do you see? Yeah,
we have some numbers now. Let's break down the unemployment rate. We do get a big jump in the civilian workforce, 532,000, but we also get 747,000 added in the household survey of people who are employed. That is a huge number. And unemployed drops by 215,000. So this looks like one of those good reasons that unemployment is falling. It's a surprisingly strong household report. And of course, the establishment report is also very strong. In the establishment report, 40,000 jobs in leisure and hospitality, which is higher than it has been in recent months, but it shows that category is still looking for people. I wonder how many of those are department store Santas coming on board. Manufacturing, as we mentioned, up 28. Government, 49, a little bit lower than the average over the prior 12 months of about 55,000, but still adding a lot. And healthcare, as always, the big gainer, 77,000 jobs.
Did you just say that was your side gig?
Yeah, I go right across the street to Bloomingdale's. Works like a charm. You don't have to commute. You know, they called me up.
I
they
can
said,
see
please.
that works.
They said, you know,
you'd be a good Santa.
Well, the beard hides a bow tie, so I get away with it.
Be a great Santa. Mike McKee, thanks for that. Let's round things up for you. Equity futures negative 0.4% on the S&P. Bond yields higher, much higher. They fade just a touch, still up by around 9 or 10 basis points at the front end of the curve. On the euro against the dollar, stronger dollar, 107.40 right now in that currency pair. In the next hour to break this down, tremendous lineup for you. Mohammed Al-Arian of Bloomberg Opinion, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM Fixed Income. Plus, I imagine, a very happy Julie Su, the acting Labour Secretary, is going to join us from the White House first, TK, in about an hour from now.
I'll say that it'll be an interesting Washington conversation as well. We continue our conversation with Michael Darden, Chief Economist, Macro Strategist at Roth MKM. Michael, once again, it is a confounding report of somewhat towards a fully employed America. Is this the productivity overlay? Is this the technology overlay into non-technological sectors where things are just simply better than we perceive?
Well, it's hard to say, Tom. I mean, the productivity statistics have been really strong over the last 2 quarters, but they were insanely weak before that. So on productivity, we just vaulted back to the pre-pandemic trend so far, which was 1.6% per annum. So to be determined on that question. This is a good report. You know, almost 200K with the downward revisions, you know, we're at or just below the consensus expectation. But we were talking about the unemployment rate moving up to the cusp of a recession signal. Now we've pulled back to 3.7 on the unemployment rate. So this is a report the Fed is going to look at and not really feel compelled that they need to embrace these early rate cuts next year that the market has priced in. Now, this could change again with the December data, obviously, but at face value, strong report, almost 200K on payrolls, unemployment ticks by 0.2 to 3.7. That's going to be viewed as still a very tight, fully employed labor market. And so, it makes sense that we're seeing a bit of risk off here and a bit of a bounce in bond yields.
Michael, does this make you rethink any of your thesis about the business cycle rolling over?
Not so far. I mean, certainly it's not an additive, decisive signal that, okay, this is, if we're up at, up above 4 for this report, then, to me, that would suggest that perhaps we've fallen into recession. So this says we're not in recession right now, but it's not necessarily an all clear signal for next year either.
Michael, you fold with Bloomberg data your economics into your equity coverage. What's the DARTA SPX call for when you're 51 years old?
Tom, we were talking before about the market really being dominated by 2 sectors and 7 stocks. So, I think for the overall S&P 500, we're going to have a challenging period. The valuations in these leading sectors are simply too high. So I think investors are going to have to look to some other areas that have been underperforming where the valuations are low. But we'll have opportunities with rising volatility next year. Michael
Darter, thank you so much with Roth MKM. This jobs day. Futures negative 14, Dow futures negative 94. The VIX well under 13, 12.90. That's most interesting. Lisa, we were at 11 basis points, higher yield, lower price on the 2-year yield. Now we're at 8 basis points. So it's the shock of it, and we've come back a little bit.
All I can say is that if anyone was doubting Goldilocks, well, you can continue trying to doubt it, but each data point that we have gotten really plays into that idea, especially with more people entering the workforce.
A difficult way to manage money in this environment. Jeffrey Rosenberg is portfolio manager for the Systematic Multi-Strategy Fund at BlackRock. Jeff, with great respect, what's the strategy that works forward given the treacherous economic waters we wade?
Yeah, this is a good report, and as we've been discussing, across the board, it's a bit stronger than expected. Maybe not on the headline payrolls, but certainly underneath. And I think that really is going to push back. And I think that's why you've seen the market reaction, the initial market reaction that you just described, is bond markets in particular, are really starting to price in a lot of cuts into next year and pricing them earlier and earlier. 3.7% unemployment rate, hard to see where the restrictiveness is coming for this Fed policy. So I think you're going to have a little bit of pushback in that narrative, in that you're not really seeing the slowdown, particularly, again, with the wage picture. Most of the support here is coming from the inflation side, and we'll have that conversation next week. But on the growth side, you're really not seeing the level of restrictiveness show up yet in the labor markets. And I think that's going to push back on how quickly the Fed's going to be able to cut rates to keep up with the fall in inflation and avoid the unintended increase in real rates.
And to Jeff's observation, Lisa, I missed this, stunning. The Bloomberg Financial Conditions Index, I'm going to use this word carefully, explodes out to an accommodative 0.62. It's Greek, right? All you got to know is explode's the right word. This is what Powell does not want to see.
Although he didn't push back as much as some people thought, at least last week in his speech. But you're right, to that point, Jeff, when you say that inflation is really in the front minds of people who are betting on this Goldilocks narrative and even rate cuts without the pain, I wonder how much their view is damaged by average hourly earnings rising more than expected and rising from the prior month. How much does that suggest a stickiness to the labor market strength and wage growth that really flies against this narrative of Fed rate cuts next year?
A little bit, and it there certainly goes in the opposite direction. But what you've had on the inflation side is really this dichotomy between goods and services. And it's the goods part that has really been the disinflation that's fueling the overall enthusiasm for the cuts into next year. The services side is held up, and services inflation is really the mapping of today's labor report and the wage picture into the broader inflation. And so that remains very supportive. So again, it's kind of the easy disinflation is behind us. This report kind of supports continued support for the broad inflation picture from the services side. And that debate, I think, will continue. And obviously what you've seen in the market is a little bit of pullback in terms of the enthusiasm. As Jonathan says, the first reaction isn't necessarily the end reaction. But I do think the overall take from this report and the wage picture is, again, very strong labor market, supportive of services inflation. Yes, it's still coming down, but most of that is being driven by the goods side. You're not seeing that supported as much from the services side.
Priya Misra of JP Morgan earlier this morning said, does it matter? She raised this question, does it matter how much the Fed cuts rates next year, considering the fact that it didn't seem to matter how much they raised rates? It didn't tighten policy that much. The long lags are long in both directions. Do you think that people are overestimating whether it matters if they cut rates in March or if they cut rates in June or if they cut rates in September, if they have stopped raising rates, and if right now what you're seeing is an economy that still is chugging along and businesses still hiring?
Well, I think the question is, does it matter for the real economy or does it matter for the financial economy? I think the point's well taken in terms of the sensitivity of the economy to interest rates. Is a different question than the sensitivity to financial markets. And I think on the latter, the financial markets, it matters a lot. And I think that easing in financial conditions that you were just talking about has everything to do with the expectations of soft landing, the collapse in inflation, the immaculate disinflation proving out to be correct and allowing the Fed to cut interest rates. That's highly supportive of financial markets. The real economy point, yes, I would concede that may be less significant. But for investors, it's going to be the latter. It's going to be the financial market.
Jeff, let's pretend you're at Carnegie Mellon. You got to sum this over from your financial chat over into the GDP chat. Does this good labor economy support a more buoyant assessment of our real GDP?
Well, I think so, Tom. And I think that's, kind of the issue here for the monetary policy outlook is that there is this question of just what is neutral, what is real interest rates, what is restrictive. And we think we're there, but you don't know until it shows up. And we've had the benefit from the inflation side, but the growth side, less so. And I think that's been the message from labor markets. It's been a steady normalization, but we're still seeing very strong labor market prints here, very strong wages, strong unemployment rates that are not really consistent with restrictiveness. And that's good from the growth side, but it may not be good to get that last mile of that 3%, 3.5% inflation down to the 2% target.
Jeff, thank you. Jeffrey Rosenberg, most often with us here on Jobs Day with BlackRock and his good work in shorter-term paper as well. Michael McKee looking at page 72 of the jobs report. What is beneath the headline data?
Well, a couple things. Lisa pointed out the average hourly earnings were kind of double what was anticipated for the month, but on a 3-month annualized basis, they're down to 3.4% from 3.7%. So the trend continues to move in the right direction for wages. The Fed looks at 3 to 3.5 as the sustainable level for wage increases at a 2% inflation rate. So they're going to still look for that. In terms of jobs, we mentioned manufacturing up 28,000. We also saw big strength in the healthcare area, which is always the case these days here, 76,800. Government, 49,000. You can see some political attacks maybe forming there, except all of it was in state and local government. Federal government, 0 additional workers, which is kind of interesting. And also, what month is it? This is November. This is the holiday season. Retail lost 38,000 jobs. So it isn't exactly clear how that happened, but
do you know off this report what Amazon's doing in the other, the online, those big buildings outside Fargo, North Dakota, where they're.
Yeah, the interesting thing is employment and transportation and warehousing was down by 5,000 jobs during the month, and we've often seen an offset there to retail as more people move to online shopping, and we didn't get that this time. So it's not clear to me whether we're going to see a big change in that for December or whether the seasonals have changed.
Mike's going to dive into the data. He'll be with us through the morning and, of course, the afternoon here across Bloomberg Radio and Bloomberg Television, truly driving all of our economic analysis. Gina Martin-Adams is scheduled to be with us here on the equity market. A little more on bonds right now. And, Lisa, we do this. Why don't you bring in Ira? And we have the 2-year yield. We had an 11, 12 basis point move. We've come halfway back, maybe a third of the way back. A little bit more quiescent move.
Yeah, what I find interesting is that the initial headline number would suggest that you might as well really start to pare back your bets on a March rate cut, and yet they weren't pared back all that much. We went from a 55% chance to now a 47.5% chance. Again, a real significant chance still priced into the market that we're going to get rate cuts by the Federal Reserve in the first quarter of next year. Ira Jersey has been parsing through these numbers as well, chief U.S. interest rate strategist at Bloomberg Intelligence. Ira, what's your take on the fact that, yes, markets moved? They're retracing some of that, even though there is really nothing in this report to suggest that the Fed should start cutting rates in the near future.
Yeah, I think that the market is in kind of risk management mode because the market does think that we're maybe now seeing a pretty significant slowdown, and certainly this is a speed bump in that kind of narrative that the economy is slowing very quickly. But like Mike McKee said, I think part of the issue here for the market is the dispersion and the distribution of the job gains and the job losses. Anna Wong and Bloomberg Economics talk about the SAG strike and the UAW strike having some effect on this. So we'll need to see a couple more prints. And obviously, inflation is still the key to all of this. So next week's CPI number will probably drive some of the narrative that we have from the Fed next week. That's where you can start to see maybe some changes in market pricing for cuts.
Ira, your claim over the years, and frankly, your team here at Bloomberg Intelligence is not only on the economics of this, the jobs report, the wither, the yields, and all that, but the confidence in the fixed income markets. I've seen a lot of gloom articles in the last couple weeks, and I've seen a lot of pros push back. What is it? Should we worry about liquidity? Should we worry about trust in the short-term paper system?
Well, I don't think we should necessarily be worried about the trust in the government's ability to pay and willingness to pay at this point, right? We'll have a debt ceiling crisis at some point probably in the future just because of the partisanship that's going on in Washington. But in terms of the size of the market versus the pipes that the market runs through, I think there is some concern there. And the government and some of the regulators are trying to nip at that at the margin, but I'm not sure that they want to take the steps that will actually help increase liquidity in a very substantial way. So I wouldn't worry about T-bills. T-bills are still very liquid. You still have a lot of cash in money market mutual funds. But when it comes to things like 5-year, 10-year, 30-year bonds, again, every once in a while you're going to see these massive moves on not a lot of liquidity. This morning, liquidity seemed okay. There was pretty tight bid offers for some pretty decent size. But there's a lot of days when we get numbers like this and just all of the bids or all of the offers just completely disappear. And when that happens, you wind up seeing these outsized moves for on data that you wouldn't necessarily expect to move the market that much.
Which is the reason why a lot of people are trying to identify where consensus is and where the overshoot could be on any given day. You started out by saying that this jobs report acts as a speed bump with respect to the slowdown narrative. Does that mean that right now the slowdown narrative continues to be the consensus? People are going to price that in, and should we get another report like this, it could cause a pretty big disruption in the opposite direction with yields going higher.
I completely agree with that assessment. I think that if we see that in December the jobs report is reasonably decent, we could easily price out March and May interest rate cut probabilities, and I think that can happen very quickly. I mean, we've gone the other way very fast as well, right? Think about it. Just a couple of months ago, when 10-year yields were at 5%, 2-year yields were at 5.25, we were not pricing for any cuts in all of 2024. So we could easily go back the other way. I've been of the opinion that the bar for the Federal Reserve to cut rates is much higher than the market's thinking. So I think that we eventually will price out those early cuts.
Thank you, Ira Jersey. Thank you so much. Really, really appreciated this Jobs Day as well with Bloomberg Intelligence. On the other side of the aisle, Gina Martin-Adams is Chief Equity Strategist at Bloomberg Intelligence. Gina, we're looking at the jobs, yield, the Fed. what our listeners and viewers want to know is, I'm so far behind in this market. What do I do given this jobs report? And folks, here's the numbers. Amy, give me this if you would on TV. I'll quote it out to radio. Year to date, Standard & Poor's 500 up 13%, the Dow up 5%, and the Gina Martin Adams NASDAQ 100 up 34%. How do you take this jobs report, better than good, folded into maybe a better than good GDP, which is clearly into a better than good stock market?
Yeah, I think it's a great question, Tom, and it's certainly one that everyone in the equity universe is contemplating at this time of year. I would point first to that difference between the Dow's return and the NASDAQ return. You see a similar difference between the S&P 500 return and the small caps return. Portions of this equity market are still in an extraordinary bear market, really reflecting the recession psychology that we continue to contend with, as everything but the jobs market indicators has been pretty sour over the course of the last 2 years. The equity market has been stuck in this sort of recessionary malaise, with a few exceptions, all being tech-related, tech-adjacent. Stocks have performed incredibly well over the course of the last year. So this is clearly not about the economy in the equity market. The economy is keeping most of returns somewhat suppressed. They're keeping small cap returns, international returns very low. But what's working in the equity market are companies that are experiencing earnings recovery, earnings growth that has nothing to do with the underlying economic numbers. So that sets you up with a really good strategy for 2024. Well, if the economic outlook changes, you've got to change your investment strategy.
Gina Martin, my strategy is to get to Lisa Abramowicz because she's got some really good questions here on the equity markets. But I want to note that equities are beginning to lift now. Futures only -4, Dow futures only -35. We've got a comeback in the market here. And if we get a comeback into next year off of month after month, our surprise in this resilient job economy, do we underestimate where those blended and tech estimates are going to be in June?
Yeah, we very well could. As a matter of fact, I think there's a very strong chance that the market is mispriced for 2024. And most people would say that the market is mispriced because analyst expectations are too high. Our work would actually say the market is not priced in line with the analyst community at all. The market is anticipating close to 0% earnings growth over the course of 2024. If anything near the analyst estimate of about 11% growth comes true, that will be another second consecutive year of upside surprise on the earnings story. While we've all been completely and totally captivated by what all of this data means for the Fed, the other half of what really drives stocks is what's going on with earnings, and we very well could be set up for another earnings surprise next year.
Which is the reason why, Gina, part of what's interesting here is that people are underestimating how much capacities companies have to keep hiring, right? The flip side to this story, which is that they see more downside to not being sufficiently staffed than upside from possibly cutting costs. This from Jason Furman of Harvard, just out. We're now 2 million jobs and 2 million employed above the CBO's pre-pandemic projections, that we are actually at a better spot than before the pandemic. We were extrapolating out. Gina, where do you see the biggest gain to be had from the figures of we're seeing right now with respect to hiring, with respect to where people are really hoping to beef up?
Yeah, so I actually think the biggest potential gains in terms of hiring are going to come from the areas that already cut. If you think about the longer term scheme of what's happened in the job market, we had tremendous job cuts throughout the pandemic experience. The sectors that did not cut jobs cut those jobs in the end of 2022 and early 2023. Those sectors are sectors like technology, communication, to a lesser extent, financials. So if those are also the groups that are experiencing the most robust earnings recovery, in particular, the tech sector is starting to really produce strong growth, communication stocks producing very strong earnings growth. Those are the segments of the market that are leading what's going on in the broader market. Those are the segments where they're already cut to the bone. If they continue to produce positive cash flow growth, positive earnings growth, we're going to see hiring come back in that space first.
Which, if you flip this on its head, you said earlier that maybe people are focused too much on the Federal Reserve and should be focused more on earnings. At what point do Fed rate cuts or not matter for equity valuations?
Oh, I think they definitely matter. If you look at something like the small cap sectors, for instance, the small cap index is trading at multi-year discounts relative to large caps. It's very clearly suppressed in terms of valuations. When you look at the S&P 500, you exclude the tech sector alone, and you've got a multiple that's closer to long-term average. So there definitely is some pent-up demand that could be sitting on the sidelines for equities. Just based on valuations alone, a cut in the Fed funds rate could go a long way to catalyzing some degree of valuation expansion in all the groups and sectors that have frankly been left behind in this very tech-specific recovery that has emerged in 2023.
Gina, just absolutely brilliant. Thank you so much for that weekend analysis. There's a look ahead with Gina Martin Adams into next week and that important inflation data, and of course into next year with what we're going to do with our 201ks. Lisa, my head's spinning. Help me here. What's your observation?
Is that it was a pretty good report, and it wasn't good enough to make people good news, bad news, which I know you love. It wasn't good enough to really cause hysteria. But it also was so good that people are now rethinking when the Fed could really start cutting rates. It potentially delays that.
I thought that Martin Adams was brilliant because she walked away from the Fed analysis to the real economy and what corporations are doing. And as she said, there's a gross underestimate of the resiliency and the adaptability of corporations in different sectors, some not all that great. We know media right now is flat on its back. But the answer here is we're seeing futures come back. The major story, for those of you on radio, spiked down S&P futures, Lisa. We've made a run to flat. We're not there yet.
People aren't fully repricing anything on the heels of this report because it's one data point and the rolling average matters more. But here's the issue. How much have people underestimated exactly what you're talking about, Tom, time and again, in terms of just how much strength there is? And if that's the case, then are people overestimating the Fed's response to it next year? It's going to be important to really understand exactly whether that even matters.
We're going to do the Fed decides here. December 13th, I think it is. We're going to do a show in the afternoon. Suddenly, the Fed decides is interesting.
Well, it's always interesting, especially now when we're in this highly uncertain time. And I'm curious whether they care about the easing in financial conditions or if they basically say, fine, it doesn't really matter because we see a slowdown in the works.
Thanks to our team, as always, a fabulous jobs day, really interesting conversations. In the 9 o'clock hour, Jonathan Ferro in conversation with the acting Labor Secretary. Good morning.